the market overall is a little bit vulnerable.
I think there is significant downside risk here, recession or no recession.
Recessions come from policy errors.
Markets are underweighting the impact of those pro-growth policies in the beginning of the year.
Definitely balanced risks looking forward into the next multiple years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500 on a 3-day winning streak. Make it 4 in yesterday's session, and looking to make it day 5 this morning. Equities up by 0.2% on the S&P. On the Nasdaq 100, just about positive. Last week on the S&P, the worst week of the year. This week on the Nasdaq, the best week of the year so far. That's the equity picture. Switch up the board and get to the bond market and look at the signal at the front end of the curve. The 2-year yield down by 6 basis points, 357.83. We have a live meeting next week, and it is very finely balanced between 25 and 50. And all it takes, Bramo, is a few comments from some former Fed officials, and now the weight starts to shift back towards 50.
Normally, a lot of articles and commentary reflects a shift in markets. The markets had clearly shifted to 25 basis points. To hear Bill Dudley come out, and who actually has supported 25 basis points before at a meeting, come out and talk about how there is this important argument now toward potentially cutting by this amount. Just to give you a sense, I think there's a strong case for 50. I know what I'd be pushing for. At the same time, you get a Wall Street Journal and FT article, suddenly it's about 50-50 whether they go 50 basis points, which would be the most undecided meeting in years.
What stands out for me is when Dudley says it's basically up to Chairman Powell to see how much support he has for being more aggressive. So if he's able to get to that consensus based on, you were at Jackson Hole, what he said, talking about how he's concerned about the labor market, could potentially he go for the 50? And then also at the same time, you have these outliers at Citi. Andrew Hollenhorst was pushing for that 50. He saw that inflation data and said, actually, it's going to be 25.
So let's run with the totality of the data. CPI came in a little bit hotter than expected on core. PPI came in a little bit hotter than expected. Then we saw jobless claims still subdued. 4-week moving average around 230,000. And yet here we are having a conversation about 50 all over again.
I think that you should keep using totality of data because that's nice and meaningless. That's sort of what we're learning increasingly, and I'm not blaming that on you, but basically that's what we're finding out. I'm not taking it personally. I mean, I think that there is this question about the totality of what data? The upcoming data that you haven't seen yet, is this an insurance cut, which is essentially what we have heard from Nick Timiraos and Colby Smith at the Wall Street Journal and FT, because that seems to be the big fear. Do they want to get ahead of a labor market that is their preeminent concern, that one mandate Fed, or are they still at least vaguely aware of inflation that's still kind of out there?
Super fired up about this, aren't you? People getting bullish in the last 24 hours. Maybe that's what sort of got Bramo started. Evercore dropping its call for a hard landing in the US economy. That's Ed Hyman. That's a big shift from them. Deutsche Bank, Binky Charter publishing yesterday afternoon, raising his S&P 500 forecast to 57.50. So we're talking about 50 a little bit more this morning at the same time that other people on the street are getting a little bit more bearish as well.
And this is the ultimate key question to me, because we had been asking this question to a lot of people. If the Federal Reserve goes by 25 basis points or 50 basis points, what's better for this market? Most people saying 25 basis points. You know, project this sense of confidence. And now the hint of 50 basis points is actually reviving this hopes of a soft landing, because this is a Fed that wants to get out ahead of this at the same time that NVIDIA just is feeling enthusiasm and nervousness from their clients about not getting enough shipments, and that just is enough.
So much snark from you. You need a weekend. Equity futures right now on the S&P 500 up by 0.2%. In the bond market, the rally resumes. Yields are lower across the curve. We're down by about 2 or 3 basis points on a 10-year, 364.57. In foreign exchange, 110.92. on euro dollar, firmer by just 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC saying don't pull the plug on risk, Jennifer Flitton of Invesco as Donald Trump pledges no taxes on overtime, and Bloomberg's Sid Phillip as union workers at Boeing walk off the job. We begin with our top story. US stocks looking to add to this week's $1.3 trillion rally going into the Federal Reserve decision next week. Max Kettner of HSBC writing, we don't think it's time to pull the plug on risk. We therefore add to US equities as Q3 warnings, or rather earnings expectations, also don't look challenging to beat. Max joins us now for more. Max, good morning to you, sir.
Good morning.
That's the equity call. I want to get to the credit call. There was a shift on high yield for you in the last week. You move that overweight from max overweight to, where are we now?
Slight overweight.
Slight overweight. What was that shift
from
about?
Exciting to boring.
So what's that shift about? Let's start there.
I think, look, when we look at high yield, it's not like it's bearish. So certainly in Euro high yield, things look still pretty okay. Valuation-wise, it looks a bit more attractive. I think in US high yield, there's partly a story around valuations. You know, you have high yield spreads around 320. There's not an awful lot to go anymore. There's not an awful lot of spread tightening that you can still see. So at some point, it gets around pure carry. And then you sort of, okay, is that still the best place where I get the carry, or is other places better? Such as EM local debt, for example, where perhaps, you know, you get higher carry, it's a bit short, it's sort of equal or similarly short duration, and it looks a little bit more attractive now, given how much has been priced in since April there, similar to the Fed. And I guess, you know, when we look at it from a total return perspective as well in high yield, if you get now these sort of 10, 11 cuts priced in by the end of this year, if you get just a few priced out, right? Like, let's say, compare high yield to equities then. If you're long equities now, if you're long the S&P, do you care whether they cut 10, 11 times by the end of the year, or they cut 7, 8 times by the end of next year? Not really, right? Like, that's not really the big tail risk anymore. The big tail risk, particularly in April or in September, October last year, was they're not going to cut at all, or they may even have to hike. The tail risk now is, well, maybe I'll do only 4 or 5, but they will be cutting. So for equities, it doesn't matter. For high yield, it matters, because obviously the front end of the curve goes up.
Well, doesn't it matter for EM as well? Can we get into EM a little bit more? What are the assumptions you're making on rates on the US dollar to make that call?
Yeah, I do think, however, that in EM, again, valuations are a little bit more enticing. If you look at EMD spreads in particular, you know, year to date, so they're sort of flattish. Of course, there's been some index composition changes as well. Yes, of course, but from a valuation perspective, certainly there's a bit more juice left compared to US high yield. So we're really at the stage now where it's not really bearish about high yield and much more bullish on the other stuff. It's a bit like, okay, you're really harvesting that carry. Where's the carry best across all the asset classes?
How much is this just a revival of the FOMO trade? Essentially, look for the biggest return and go. And that's essentially because the Fed is cutting rates. And so, yay.
Yeah, pretty much. I think it's sort of the, you know, we were saying in 2021 that it's all pretty much a YOLO world. Right? And it was sort of the return to YOLO. You could argue that's sort of what we're seeing, for example, this week. But let's be honest, we could also sit, maybe by the end of next week, we could sit here and you guys talk about $1.5 trillion being wiped out again. Like, if we had this chat last Friday, we wouldn't be that upbeat. No, we would all be like, oh my God, is this recession? And, you know, are we closer to the end now? And is this the start of a bear market? And what is commodities trying to tell us? And all this sort of stuff. And now we sit there and we're like, YOLO, everything's great. So, you know, this is how much it shifts within a week, if we're honest.
We were having a conversation to start the show about 25 versus 50 basis points. And I wonder how much you were rolling your eyes and how much you were actually saying this is going to matter to the market.
Do you want me to roll my eyes? I don't know.
Happy European who actually can go skiing on his weekends. But I am curious about whether you are seeing a market that is likely to sell off in response to a 50 basis point rate cut or respond with that cheer and YOLO.
Yeah, so it depends. I think they would have had the chance in the last few weeks to say, look, we're so comfortable with this disinflation picture. If they had, look, we're so comfortable with this disinflation picture, look what has happened since April this year. We've had super core down, we've had all these, you know, all these components down. So because of disinflation, we could cut higher, right? We could cut more, we could start more aggressive. The problem now is that, of course, particularly with Jackson Hole, you said, oh, we're attentive to growth risks more than inflation. So the problem is if you start with 50 now, particularly with what John was saying in terms of the data, the totality of the data, you know, sorry, not making fun, of course.
No, of course not.
Of course not.
It's not my language anyway. Why are we blaming me for that? That's Chairman Powell. Carry on, Max.
So if we look at that, then the last couple of weeks actually has been really good. Look at weekly same-store retail sales data. It's been picking up from 4.5% to 6.5%. Now, when we look at jobless claims, you look at weekly consumer confidence data. You look at, you know, some of the electricity output. Look at the Dallas Fed's weekly economic index. Look at the GDP now from Atlanta Fed. We're talking 2.5%. So it just doesn't warrant it currently. So the risk is if you go 50 first, the market will say, what do you know that I don't? What am I missing? And I think that's what the market will take, a bit of like, oh God, I don't like this.
But Max,
I really don't like this.
Can't the chairman just clean that up in his press conference?
I think he could, but I think particularly with Jackson Hole, they've sort of missed the boat. Right? It was particularly also with Jackson Hole that they could have said, look, it's really because of inflation. It's really because of the disinflation that we're so comfortable with. That is why we could be cutting much more aggressively from the start, right? That's why we could sort of rush out of the gates and be like, we can cut 50. Yeah, growth has been a bit wobbly, but we're really comfortable with this still. It's just because of disinflation. And they sort of missed the boat on that.
Since you're visiting us from abroad, I have to ask you about the U.S. election. How concerned are you about the risks that are tied to November?
Yeah, look, not an awful lot, but because when we look, for example, at 2025, I think people talk a lot about the US election. I'm not sure how much people have positions on. Certainly, when you look at our tactical asset allocation convictions, they are really not particularly tied to the US election, because I think what we're missing, looking a bit into 2025 as well, there is the debt ceiling issue looming, for example. But the Treasury has made it clear that we want to have these 700 billion stocked up in the Treasury General account in order to be able to pay that down, which could be at least perceived by the market again as temporary stimulus, similar to what we had in Q2 last year, which is actually pretty good. Now, that's independent of the election. We know that in 2025, of course, there's a couple of those tax cuts from 2017 expiring. Again, that's independent of the election. We're going to have to deal with that. There is some sort of fiscal cliff awaiting us. Perhaps second half of next year when the negotiations start, there is going to be something looming. That's independent of the elections.
Any evidence from your conversations that the Europeans are willing to de-risk from US assets ahead of all of that? Are they concerned about it?
No, not at all.
Not at all?
Not at all. I think if anything, we've seen in the last, particularly, let's call it 5 months, we've seen the opposite. I think we've had this sort of long Europe trade into April, call it April, May. Long Europe, perhaps long Japan, a bit of diversifying. Is the ex-US outperformance, is that really now kicking off? And in fairness, when we look at all the activity data, when we look at the high-frequency data, it's really strong still in the US. We're talking about the fiscal picture, the fiscal support. It's really strong in the US. Look at what Draghi was saying this week around, come on, we've got to be supporting more, right? We've got to be supporting more. And where it's happening is here. It's in the US. So if anything, then you've got this, you had the French elections, of course, so there was these sort of concerns around that as well, whether unwarranted or warranted, don't care, but all of that really led a little bit more the inflow picture back into the US.
Max, it's good to see you here in New York. Thank you, sir. Good to catch up. Max Kettner there of HSBC. Futures positive on the S&P 500. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Boeing factory workers have walked off the job in the first strike since 2008. Members of its largest union, which represents over 33,000 employees, voted overwhelmingly to reject a contract offer and then walk off the job. The offer would have raised wages by 25% over 4 years and lowered employee health care costs, but union members expected a far greater increase. Both parties have expressed interest in getting back to the bargaining table. House Speaker Mike Johnson is likely to need support from the Senate in order to avert a government shutdown later this month. Hardline House Republicans rejected Johnson's stopgap funding bill this week. The deadline, September 30th. Former President Trump has vocally called for his allies in the House to reject a continuing resolution unless it includes a separate bill requiring proof of citizenship in order to vote. Nippon Steel and U.S. Steel sent a letter to President Joe Biden earlier this month on the Japanese company's proposed takeover. The letter was signed by both company CEOs. Nippon Steel has been mounting a last-ditch effort to try to muster support for that $14 billion takeover attempt. It still, though, faces widespread political opposition in the U.S. ahead of the presidential election in November. That's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, another rally, another tax cut.
As part of our additional tax cuts, we will end all taxes on overtime. That's what we're doing because this is a good one. And I think it's going to be great for the country.
In 2 months, there'll be no taxes left. That conversation up next from New York this morning. Good morning. Live from New York City, welcome to the programme. Equity futures on the S&P 500 firmer here by 0.2%. Bond yields moving back in. We're down 3 basis points on a 10-year, 364.57. Under surveillance this morning, another rally, another tax cut.
As part of our additional tax cuts, We will end all taxes on overtime. You know what that means? The people who work overtime are among the hardest working citizens in our country. And for too long, no one in Washington has been looking out for them. It's time for the working man and woman to finally catch a break, and that's what we're doing, because this is a good one. And I think it's going to be great for the country.
So here's the latest. Donald Trump looking to turn the page from Tuesday's debate with a pledge to end taxes on overtime wages after 40 hours a week. The Trump campaign moving on to California, with the former president set to hold a news conference and a private fundraiser. Joining us now to discuss is Jennifer Flitton of Invesco. So, Jennifer, I've got to ask you, how long before we see a rally with the vice president and she opens up with, "We will end all taxes on overtime"?
That's right. She did follow him on the no taxes on tips, so we'll have to watch this one closely. I think she's pointed to some Department of Labor regulation that happened under his administration. I think she wants to move more towards the regulatory side than he on the tax cut side. So we'll have to see. Stay tuned.
Jennifer, what we've heard so far from the Trump campaign, and then to John and yours point, copied in some extent by some of these from Kamala Harris, is it's going to be about $4 to $5 trillion in just extending the 2017 TCJA tax cut law. There's going to be ending tax on Social Security, no tax on tips, lowering the corporate tax rate to 15%. Now he's proposing no taxes on overtime work, and then you have to add in what J.D. Vance is calling for, an expansion of the child tax credit plan. Out of this entire smorgasbord of cutting taxes, what actually can get done, do you think, in 2025?
Right, you're right. There is a huge amount, 4.2, some have estimated 4.5 trillion by the time we actually get to it. The negotiation over the provisions that are expiring in 2025 on TCJA. And it's going to it's going to be mostly determined by the makeup of Congress, right? So if Trump does come in and he has a Republican trifecta, meaning a majority of Republicans in the Senate, majority of Republicans in the House, that allows for the reconciliation process to happen. And that's not going to be simple when you have $4.2 trillion on the line here and a lot of aspirational promises. But if you do have divided government, whether that's Trump in the White House or Harris in the White House, it's going to be much tougher negotiations in trying to get some sort of extension past 2025.
So what is your base case as of now?
Well, I have to know what the makeup of Congress is, but I think I do know that the likelihood of the Senate is that it's going to be a Republican majority. Right. The Cook Politico report has now sort of given a lean Republican to the Montana seat. We know West Virginia is consensus is it's going to be a Republican seat. So then you have 51 right there. But these are slim margins. We'll see if Republicans can add to that in possibly Ohio, possibly Maryland, possibly up into Michigan. We'll have to see. But even if they get to 52, 53, you're talking about a really tight negotiation. And the House, whether it's Republican or Democrat, it's going to continue to be very tight margins. And getting things done in those tight margins, it's very difficult. So tax is definitely going to take up all the oxygen in the room next year.
Very difficult, especially considering right now they're still debating on whether or not they can keep the government open until the end of the year when you're looking at the makeup of Congress. When Trump comes out and talks about this, he says it's about getting blue-collar workers a break. This is something he ran on, we saw in 2016, 2020. Is it still going to land a punch this time around?
Yeah, I think this time around, what is affecting voters most and what we're seeing in the polls and what we've consistently seen over this past year in polling is that fundamentally the issue that is driving folks to the polls is the economy and how they feel in their pocketbooks, right? The tightness. And so any sort of promise for relief, I think, is what both of these candidates are trying to reach working class voters with.
I was looking yesterday at the bond auctions and the day before. It seems like markets are not taking any of these proposals seriously. Would you agree with that?
Well, I think that these are aspirational promises. So I think that's exactly what you're hitting on here, right? And this is what elections are. These are if I had my way, and we know that's not how government actually works, that there is a checks and balances. It is a negotiation with Congress. But you do have priorities of both of these candidates that they're going to go into any negotiation with. And let's face it, the leverage is with those who have the mandate. And if there is a strong win on either side, then you're going to have a mandate going into these negotiations next year.
I love how you frame it, a wish list. And I'm curious what sentiment we're getting from the wish list that goes beyond just taxes. Yesterday, the former president, Donald Trump, also posted a video to X embracing digital assets, saying we're embracing the future with crypto and leaving the slow and outdated big banks behind. He's held rallies having to do with crypto. Do you understand the focus and the wish list item of crypto in his sphere?
Well, it's been really an interesting year in this area. And there has been, legislatively, the hard work, the technocrats on the Hill have been trying to create some sort of digital asset market structure. But they have had a lot of pushback from the SEC. And so I think what Trump is trying to relay,
I think we've lost that connection.
And what he has been doing in a lot of meetings with top crypto.
Carry on, Jennifer. It just cut out just for a second. Sorry to distract you, but please carry on. It just cut out just for a split second. Forgive me. Carry on.
Yeah, absolutely. So essentially what you've seen him do is really be open to the crypto space in a way that you've seen with a number of Republicans on the Hill. They've been trying to create this market structure. They've been trying to do something on stablecoin, digital assets, DeFi, blockchain in general. And he is trying to tell these folks, hey, I'm going to be the president for you. I'm going to put in an SEC chairman who's going to allow for this space here in the United States, which really they need that regulatory framework in order to take hold.
Jennifer, thank you for your thoughts. Apologies about the technical issue on our end. Jennifer Flitton there of Invesco. Jennifer, thank you. Thank you very much. I think no one takes it seriously for now. I think the base case at the moment is divided government, and if you get divided government, the tax cuts expire, and that's bond bullish. But if we wake up the morning after the election and someone's got a sweep, then I think fixed income starts to take things a little bit more seriously.
I think it's important to recognize that the market is not taking it seriously. So we can't get a real check on what the response function is going to be. I do think, though, to Jennifer Flitton's point, this idea of taking some sort of conclusion from the wish lists of what they want to do in terms of what direction things will be going in. I think that's important, especially when it comes to some peripheral industries like crypto, like Fannie and Freddie, and some other issues.
Also, what's interesting is she mentioned what's going on in the Senate. It is really starting to look like the Republicans are going to be able to flip the Senate. You have the Cook political report talking about Montana is now lean Republican. So if there was to be Harris in the White House, and then you have the Democrats controlling the House potentially, that is serious gridlock, and it cannot be progressive policy proposals, and there'll have to be serious negotiations and debates about where the tax policy is
That's bond positive. I'm not sure where that leaves equities. Where does that leave stocks?
We'll see. I think that there's a sense that going forward, stocks and bonds are going to move in opposite correlation. That what's good for bonds is bad for stocks, and what's bad for stocks is good for bonds. And that basically the proposal from Harris is going to be good for bonds and bad for stocks, and flip it around on the other head. Whether it actually works out that way, we'll see, because in the past, bonds and stocks have actually moved in positive correlation over the past few years. And what's to say that that's really going to shift materially going forward?
Based on current proposals, you'd have to imagine that this market would treat a blue sweep horrendously in equities. The idea that you're taking the corporate tax rate from 21 to 28, game over. Blue sweep will have conversations about taxing unrealized gains as well.
We will. At the same time, you hear other arguments that next year, if there is a blue sweep, you could also get some sort of fiscal proposal that could bolster things. And on the flip side, you get all the negative stuff up front with a red sweep. You could see all the arguments being made. People can make up whatever argument they want because it's all wish list at this point.
If there's a blue sweep, though, the market would also look at it in the sense questioning, where are the centrists in the Democratic Party? Kirsten Sinema will not be there. Joe Manchin will not be there. So there is that propensity now, potentially in a Senate, to do more than they were willing to do in the past.
2 more months of this coming up on the programme. Boeing workers walking off the job for the first time since 2008. From New York City, this is Bloomberg. Four-day climb on the S&P 500. The advance continues this Friday morning. Good morning to you. Equity futures look like this. Positive by 0.2% on the Nasdaq 100, up by 0.1. On the small caps on the Russell, decent run here, up by 0.75%. Thank the bond market. Front end of the yield curve, the 2-year yield down for a second consecutive day. At the front end of the curve, we are negative by 6 basis points, 357.83. The why? It's certainly not the economic data. CPI came in a little hot. Likewise on PPI. Jobless claims were pretty subdued. This is about the Fed speak, or rather the former Fed official speak, in the last 24 hours.
Yeah, there were three items that came out that were kind of the 1, 2, 3 punch. The first being Nick Timiraos in the Wall Street Journal writing a story, putting a greater emphasis on a 50 basis point rate cut, which is unusual given the fact that markets have basically come and coalesced around the idea of 25 basis points. Right now, the market is pricing in about a 50% chance of either 25 or 50, which is so unusual. It has been years, John, since there has been this level of uncertainty, unclarity, a sense of a real live meeting without necessarily a clear conclusion. And it comes with rhetoric that doesn't really match the market sentiment, but people are going with that because you know something I don't.
I think it's been about a year since the 2-year yield did not drop on a Fed decision day at a Chairman Powell news conference. Do you remember we were counting? I think it's been about a year since that happened.
And this comes with a material shift in Jerome Powell. And can he move the rest of the committee toward his view? We heard from Chris Waller. He was open to a bigger move. Should the data warrant? Did the data warrant? Is it the argument you've made? You talk about the totality of data. You just mentioned that inflation is not dead. We saw, upside surprises on housing costs. At the same time, people are saying it's in the right direction, and we're hearing out on all sides of the Atlantic. Right now, it seems like it's a toss-up, but it is odd. The emphasis on a couple of articles and commentary over the past couple of days.
Yields coming in, push it through the FX market. The dollar weaker against the bulk of G10. Dollar yen down by 0.9% at 140.52. Euro dollar looks like this, slightly positive on the session to about 110.90. This from BNP Paribas saying the dollar bull run has come to an end. Our forecasts imply gradual weakening to the dollar to 115 in euro dollar, 132 in dollar yen by year end 25. We note that these forecasts are conditioned on, this is the important piece, Lisa, a soft landing as well as a Harris presidency and a divided government. So there's a lot hinging on that idea that we get a divided government come November.
And that would essentially be dollar weaker, and that would create a bit of strength for the euro. You talk to 3 different strategists in the FX space, you'll get 3 different views. You have Morgan Stanley coming out talking about parity. You have Frederick Ducruzet of Pictet Wealth Management talking about how essentially this is an ECB poised to cut much more significantly than they're even saying, just simply because of the weakness. So, pick your poison, either a Harris presidency or Germany.
If you get tariff man back in the White House, it's dollar ripping, right? Dollar stronger.
He might not say that he wants that. He wants dollar weaker, but that is essentially what people are expecting.
Likely the consequence. Under surveillance this morning, former New York Fed President Bill Dudley saying there's a strong case for 50 at the Fed's meeting next week, citing a slowdown in the US labour market with risk to jobs greater than lingering challenges to inflation. You will remember, going into the July meeting, Bill Dudley made the argument they should be cutting then. I think this echoes the fact that they didn't cut back in July.
Yeah, so how much are you trying to make up for it, and how much do you jeopardize the communication tactics by saying, we're catching up, there is a risk in the market that we're not recognizing? It is notable that Bill Dudley previously had really supported a 25 basis points. So there wasn't a lot of daylight between July and September as long as the path was clear. Why now?
He said the facts have changed, didn't he? So his views changed. Let's get a move on.
Back in July.
Yeah.
But the facts haven't changed from July till September. So the question is, how much are you actually giving the wrong signal to the markets by cutting for 50 basis points? I mean, that's the discussion around 25 versus 50. Does it really matter whether you started in July or September, or is it just the signal that you're actually on this path?
We can talk about this all morning, and I think we'd all agree that I know, there's a lot of nuance here. Beyond just 25 or 50, you can achieve the same through a 50 with a 25 by leaning very heavily on the dot plot and forward guidance. And what comes out of the news conference, and Annmarie mentioned this at the top of the hour, what comes out of the news conference is equally as important. So 25 or 50, I don't think all 25s are created equally. You come out at 25 and signal this is the first in a string, start talking up a destination and the journey back towards neutral, start leaning in that direction heavily. That's a very, very dovish 25.
I like the idea of heavy lifting with the dot plot. We're going to be analyzing the statement of economic projections and understand, can they cut their expected benchmark rate while also not necessarily moving the growth forecast? And if that's the case, they will be signaling that it is not because of weakness that they're going to be cutting much more significantly.
The main event next Wednesday. Elsewhere, former President Donald Trump pledging to eliminate taxes on overtime pay. The plan would boost take-home wages after 40 hours a week. Trump also vowing to cut mortgage rates to 2%, despite only limited influence over the Federal Reserve. So let's park the mortgage argument just for a second. Tax cut after tax cut. And I joked about 10 minutes ago that I'm waiting for Kamala Harris, the vice president, to come out and basically say the same thing. But that's what happened last time. Why wouldn't it happen this time?
Well, yeah, she might get asked the question, what do you think about this new policy proposal from the Trump camp? Do you also agree that those who are working overtime shouldn't be taxed? And she could say simply yes. And then technically she'd be copying Donald Trump. But as we just heard, a lot of this might not happen. I mean, it is the Oprah Winfrey election of tax cuts. It's on everything when you look down the list. Extending TCJA. On top of that, ending tax on Social Security, ending tax on tips, lowering the corporate tax rate. We are talking about trillions of dollars. And all of this feels like spaghetti on the wall to get people out to vote. Will it actually happen? A lot of this, likely not.
You said it might not happen. Arguably, it won't happen, most likely. And here's the question that I have. Have we ever had an election where people took the proposals less seriously because everyone said that none of this would happen? Because essentially that is what the market is saying, which I think is really notable. So it's sort of, why not say that if no one's going to really cross-check it and say, we believe you and we're expecting it? It seems like everyone's just saying, oh, it's nice that you have to say this to cater to these constituencies.
The overwhelming base case is gridlock in Washington. Like, that's the overwhelming base case. And I think to some extent that's contributed to the bond market rally we've seen over the last few weeks as well. If you get anything but that, got a very different story in this market.
People don't believe there will be a material change. And perhaps it's just because you can't trade in something that you don't know. But it doesn't seem like people are taking it truly seriously in the bond market just yet.
I agree with you. Let's turn to Boeing. Some real news out of that company. Boeing factory workers walking off the job for the first time in 16 years. The strike halting production at the planemaker's Seattle commercial jet hub. This coming after members of the International Association of Machinists and Aerospace Workers rejected a contract offer with 96% voting in support of a strike. Bloomberg's Sid Phillip joins us for more. Sid, welcome to New York. It's good to see you.
Likewise.
Walk us through what happened here. Why is this strike happening?
So Boeing's been in negotiations for the last couple of months for a new wage deal. So the last time they had a strike was in 2008. They've been sort of working on a brand new wage deal that is the first time in sort of 12 years that they're working on a completely new deal that would get basically their workers a brand new deal in terms of just being able to get higher wages and essentially get, because they've talked about how they've been hit by inflation and they've been working towards getting a brand new wage deal. And so for Boeing, they're in the midst of a crisis. They've been sort of trying to get out of this position for a while where they've been burning cash. They've had ever since the Alaska escape back in January when the door plug fell out. They've basically had to slow down production. And so for Boeing, they're in a very tricky spot. And they were hoping to sort of make this problem go away by sort of offering them 25% over 4 years. And they said, that's the best we can do because of our constrained position.
Yeah.
And the workers said, no, thanks. We want more.
What is the ask? Do we know precisely what the number is?
They were talking about 40% when they began negotiations. And so that was the ask initially. And there's a lot of anger about the plan to cut an annual bonus. And they were sort of hoping to restore pensions, hoping to get better healthcare. And that's the sort of position where they would like Boeing to take them.
The last two strikes we had were in the 90s and then 2008. And a lot of what analysts are saying is that this means this strike could go into mid-November. Is that what you think this can actually be, mid-November? I say that because there's a really important political calendar as well.
Exactly. I mean, everyone's watching to see how long the strike will go. And both the union and the company are desperately trying to make this happen quicker than the sort of 50 days that it took in the last couple of strikes, because any sort of stoppage for 50 days is estimated by some analysts to be about 3 to 3.5 billion in terms of affecting cash flow. So essentially for Boeing and for the workers, everybody really wants a deal to be done. It's all dependent on whether or not Boeing can actually get to where the workers want them to go and the workers accept what they offer.
Reputationally, this is a brand new CEO. How much blow is this for him? Or will investors understand that this was the cards he was dealt?
Investors will understand this is the cards. I mean, Boeing's been telegraphing that this negotiation with IAM 751 was coming up at the start of the year. So this is something that was expected, but at the same time, everyone was expecting the new CEO to be able to sort of quell this issue and make sure that Boeing can get back on track, get production going, because this will stop production for Boeing. And essentially, 737 MAX, which is their biggest cash flow generator, will basically come to a grinding halt or close to a halt. And that basically means no cash for Boeing. And so Boeing's in an even more precarious position.
So no one's listening. Who's right here? Is it the workers or is it the company? Just simply because I was reading this and I'm wondering, well, how much is this part of the problem? And the reason why you have had these lapses is because workers haven't felt rewarded and are leaving versus taking advantage of a situation. Which is it?
I think it's a bit of both. I mean, I think there is, obviously workers in the aviation industry are sort of very highly skilled workers. They're sort of very focused on quality, and essentially the industry is highly regulated. At the same time, the workers feel they've been sort of given the short end of the stick because essentially the company has sort of been struggling and they've been sort of hoping to get a pay rise, and they've been talking about how they haven't been given adequate pay rises, especially with inflation where it's at. And essentially they've had to work on this current deal where they previously lost their pensions, they've had worse healthcare, and so they're hoping to restore some of those benefits. And they are in a very good position at the moment because Boeing really needs to build airplanes. And if they aren't able to build airplanes, then it is a big problem for them.
Their strike timing historically is not the best. 2008, the last time they did this, Lisa, going into what many people are still anticipating to be somewhat of an economic downturn.
Yeah, is this sort of the peak in terms of marking the end? Yeah, exactly. And we've talked about this before. You do wonder if they're a little late to the game and whether they're trying to squeeze a company that's kind of squeezed out right now.
Hey, Sid, it's good to see you here in New York. Thanks for being here. Thank you. Bloomberg's Sid Phillip there on the latest strike out of Boeing. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Chinese government is raising the retirement age in the country for the first time since 1978. Men's retirement age will increase from 60 to 63. The women's will rise from 55 to 58. That from a report from the government. Those changes are set to take place over 15 years. It will likely slow a decline in the labor force, but it does risk angering workers who are already dealing with a slowing economy. Vice President Kamala Harris raised $47 million in the first 24 hours following her debate with Donald Trump. That amount coming to nearly 600,000 individual donors. It also comes on top of the $361 million that she raised in August, more than double the $130 million that Trump pulled in. Trump is seeking to close the fundraising gap with a series of events scheduled today in California. People familiar say OpenAI is releasing a new model capable of performing some human-like reasoning tasks. Internally, it's known as Strawberry. The tool will be able to solve multi-step problems, including complicated math and coding questions. The timing, though, it's still unclear, but a release could be available to some users as soon as this week. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, a bond market looking for an anchor.
We have excessive data point dependence. We don't have a dominant economic view, so we get swung all over.
That conversation just around the corner. Live from New York City, you're watching Bloomberg TV. Four-day winning streak on the S&P 500. We could make it day 5. Equity futures positive by 0.2%. Quite a bond market rally over the last few weeks. We're down 3 basis points on a 10-year this morning to 364. On twos, we're down 6 basis points, almost 7 to 357. Under surveillance this morning, a bond market looking for an anchor.
We have excessive data point dependence. We don't have a dominant economic view, so we get swung all over. We are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power of forward policy guidance.
So here's the latest. Traders remaining at odds on the Fed's path forward from here. Former New York Fed President Bill Dudley making his case. I think there's a strong case for 50. I know what I'd be pushing for. It's basically up to Chairman Powell to see how much support he has for being more aggressive. Joining us now to discuss, Cayla Seder of State Street. Cayla, it's good to see you. Welcome to the programme.
Thanks so much for having me.
25 or 50 next week. What are you leaning towards?
I'm leaning towards 25. However, I think there's a really valid case for both sides of the coin, 25 and 50.
Is there a stronger case for one versus the other?
I think 25 because it gives the Fed a little more optionality to speed up the pace of cuts if they need to. I think the last thing they would want to do is overcut and then be in a more of a tighter predicament.
So take us inside the State Street headquarters. Everyone agreed with you. 25 basis points was the most likely. And then the Wall Street Journal article dropped.
Yes.
And then the Financial Times front page. The Fed really considers 25 or 50, seems more on the edge than what markets were projecting. Then Bill Dudley comes out. How much do you guys turn to each other and say, this seems like a signal?
Yeah. I think at the end of the day, we have to look at the level of data that we have. So, for example, the claims data this week. Initial claims signal that the labor market is still in an okay spot. And when we look at the CPI data this week, you have to look at core and the housing component as well. And I think it gives a little trepidation around, is inflation really under wraps?
So I guess that this is the argument that we hear from a lot of people, which is why the market coalesced around 25 basis points, which was the reason why people were so surprised to see that 50 was so squarely on the table. I guess, has the totality of data changed in terms of the Fed's reaction function after Jackson Hole?
Yeah, I think it's still data dependent. And because we have that data dependency and the data that we've gotten since Jackson Hole really hasn't screamed recession, that makes the case for 25 instead of 50.
This 2-year yield has dropped a lot over the last month. It's dropped a lot again over the last few weeks. We're down to about 358. The yield curve, 2s versus 10s, is positive 7 basis points. That's a recently new development, pretty fresh over the last few weeks. I think the first time we've seen that positive in the last 2 years. You're looking for the potential here for a bear steepener. Just walk us through what that bear steepener is and why you think long-end yields could actually start to inflect higher.
Yeah, so on the short end, I think you have the case where, all right, you have an economy that's still okay. You have really strong GDP forecasts. Maybe we need to take some of those cut expectations out. And then on the long end, you still have some concerns around recession as well as fiscal concerns, I think, that are a bit longer term.
Let's get to the fiscal concerns.
Yeah.
Does the election make a difference?
I think it makes a difference for the bond market, rather. Equities, I think, are a little bit more nuanced. In the past, we've seen the initial knee-jerk reaction kind of reverse, but I think that fiscal question is going to become a concern regardless of who's in Congress and who's president.
What is your base case at the moment?
That's a tough call. Fortunately, I am not our go-to political expert. However, I would say I think that's why in the equity space, we're really, really focused on what's happening on the monetary side of things.
When it comes to what happens with policy next year, you have Kamala Harris talking about a 28% tax cut, Donald Trump talking as low as 15%. So you look at all these notes, Goldman Sachs, RBC, they're saying this means for the S&P 500, it's going to be potentially good under tax policy of Donald Trump, less so under Harris. But then you add in things like tariffs. And some analysts will say, if there's a Trump presidency that's going to be inflationary and the Fed may actually have to hike, if there's a Harris presidency, she's going to go lean less hard into tariffs, even though she might use them, and the Fed may actually continue on a cutting path. How do you put all of these different potential policy objectives in one place ahead of the election? Where do you hide?
Yeah, I think when you take in the fiscal side of things and the monetary side of things, and you look at what's driving markets right now, there's a lot of different variables. And because there's a lot of different variables, I think you have to lean on the side of slightly risk averse. And what I mean by that is we're not as risk averse as we would say in some other cutting cycles. However, I think it means this isn't a buy everything situation. So earlier in the summer when we saw small caps really rally, we were kind of questioning that. Why is that the case? And simultaneously, I think we still can see an environment where equities do okay, but we need to be selective. And so what that means is really going to places of quality. And that's where we want to hide because of this uncertainty around elections, monetary, hard landing, soft landing.
You talk about utilities in your note. On this program a lot, we talk about whether or not that's defensive or actually growth, because how tied it is to the AI revolution. How do you view that sector?
I think it's kind of in the sweet spot, actually, where it can benefit from some of this AI trend, but you still do have some of those defensive qualities. And so I think that's actually a good thing right now, where it's a little bit on the fence of both. But given where we see tech going and that pull, it actually makes utilities a little more attractive, I think, than years past.
When you take a step back, would you say that right now the bigger risk in markets is actually inflation than, say, some of the hard landing discussions? And I ask this because person after person has come on and said they're not worried about runaway inflation, but this feels like a market that's gotten overly complacent with the idea that it is truly dead.
Yeah, I think it would be a mistake to ignore both sides of the dual mandate. And I think a year ago or 2 years ago, when there was an emphasis on inflation, it's because inflation was really extreme and the labor market was really tight. As we've gotten closer to balance, I think the degree with which that you can really focus on one or the other shifts, and you need to keep both in perspective. And the case to only focus on one is much different now, and I think you really can't forget about that inflation component. And we saw that in the report this week.
So when you take a step back, if you see inflation as the bigger risk, that would seemingly suggest that bonds are in a worse position right now, and stocks are actually in a better position, because we've seen stocks do really well with inflation and with pricing power. So wouldn't that arguably be sort of bonds bad, stocks good, at least on a tactical basis?
I think it's nuanced. I think I think nuanced is the word of the day, word of the week, word of the month. Within the equity space, I think it comes a lot down to concentration and where you want to broaden out. So what I mean by that is, on dips, you still like tech. When the market is at highs, that's an opportunity to shift into some of these defensive spaces. And I think at the end of the day as well, avoiding some of those cyclical places within equities makes a lot of sense.
Cayla, it's good to see you. Thanks for coming on the show.
Thanks so much for having me.
Thank you very much. Cayla Seder there of State Street Global Markets. You can feel the tension right now in some of the research on Wall Street, the difficulty that people are having calling this market. Ed Hyman of Evercore, renowned economist in Wall Street for decades, said this: very difficult decision to raise the forecast. History and experience say to stick with a hard landing outlook, but he's not sticking with it. He's now looking for a soft landing, and he offers a whole bunch of reasons. In fact, Lisa, he offers 10. So allow me to go through the arguments for a soft landing, according to Evercore. Unemployment claims are still very low. The economy is still awash with liquidity. Consumer net worth is still advancing. Inflation is slowing and lifting real consumer incomes. The solid consumer income proxy, advancing corporate profits, boosting employment. Fed funds likely to be cut next week, 25 or 50. Global short rates are already declining. Seeing that again on the board this morning. Housing's still okay. And then you've got this massive AI build out. You put it all together and he's abandoning his hard landing call.
Well, and most people are. I mean, the only person I can think of off the top of my head is Andrew Hollenhorst, who still is really leaning into this whole hard landing and talking about the need for the Fed to go much more aggressively. Key question in my mind is less who's right, because we're not going to know for a while. It's where are the risks building to what's priced in and what's not. And honestly, fewer and fewer people are talking about inflation at a time that rates are making a really dramatic historic rally. And that, I think, has to come back on the table a little bit more as you talk about long-term, what is the destination, which is a question, frankly, that the Fed has not been willing to really address.
You mentioned Andrew. His mind might change again next week based on US retail sales. Your week ahead looks like this, by the way. It's worth going through. So a little bit later this morning at 10 a.m. Eastern Time, we'll get UMich consumer sentiment numbers. Then we'll hear from the presidential candidates over the weekend. On Tuesday, the big data point, retail sales. Retail sales data. This final piece of information, just as the two-day FOMC meeting kicks off and concludes on Wednesday. And for Andrew, if that comes in very soft, then maybe if you're looking at a very finely balanced decision, maybe that's enough just to tilt things in one direction versus the other.
And certainly, Andrew probably has company based on some of the rhetoric that we've heard out of articles, as well as Bill Dudley, where it seems like Jay Powell really does want to cut more aggressively because they feel like they should have maybe cut in July as well. Key question, though, again, we keep going back to it. If there is weakness, why are we not seeing it? And I think that's an important question. If there is weakness, why are we not hearing it from the retail CEOs who still are saying the consumer's hanging in there? Why are we just hearing about discretionary spend and competitive edge much more?
Choiceful. Word of the moment for them. Jobless claims still subdued. That's still a big takeaway, I think, for many of us. Equity futures on the S&P 500 pushing higher by 0.25%. 4-day winning streak on the S&P 500 into Friday, looking to make it day 5, up 0.2 on the S&P. On the Nasdaq 100, up 0.1%. And the outperformance on the Russell, the small caps, up by 0.8% off the back of this rally in the bond market this morning. Up next on the programme, the second hour of Bloomberg Surveillance. The lineup looks like this. Steve Auth of Federated, Bloomberg's Josh Wingrove, Sharon Miller of Bank of America, and Vishy Tirupattur of Morgan Stanley. All of that still to come from New York City. Good morning.
It's a very strange economy because a lot of the strength that we had, a lot of the overheating that we've had has gone away, but it hasn't really been replaced by any obvious weakness.
The odds of a hard landing in the Fed's odds have tipped higher, but they're not terribly high just yet.
The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
At some point, volatility spills back to the real economy. And the only thing keeping this real economy going right now is the labor market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
4-day winning streak on the S&P 500, looking to make it day 5. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, with equity futures up by 0.25% on the S&P and some real outperformance on the small caps. The Russell looks like this, up by 0.75%. The small caps not the dominant story, though, this week. The Nasdaq 100 heading towards its biggest weekly gain of the year so far, up by around about 5%. Thank the bond market, the 2-year yield is down another 5 basis points this morning, 3.59, even with hotter CPI, even with hotter PPI, and even with jobless claims. Staying pretty subdued, Lisa. The data so far this week does not scream, let's go 50. It says, I think we're going 25.
But it seems like maybe people have other ideas, which is the reason why the market is now pricing in an equal chance of 50 versus 25, which would be really the first time going back years since we've actually seen a live Federal Reserve meeting. I just want to point out, you pointed to all the data being okay. 2-year yields are down more than a full percentage point from the end of June. It just gives you a sense of how far we have come down as people reset their expectations for the Fed and the destination as well.
In the commercial break, I was counting. I think we're at 7 consecutive meetings that the 2-year has rallied. The yield has dropped on a Fed decision day. Chairman Powell likes to outdove where the market is. Is that where we're going on Wednesday?
That's the reason why that feeling was the reason why Bill Dudley's words carried so much weight. Does this Fed chair have the ability to convince the rest of the members to go more aggressively? That's the reason why the Wall Street Journal and the Financial Times articles got people's attention, because suddenly you started talking about the idea of insurance cutting to get ahead of potential weakness.
When Dudley came out and talked about this, and he says it's basically up to Chairman Powell, it feels like Powell wants to go there. Can he bring the rest of the committee along? And then he says the question is, why don't you just get started? Dudley is starting to sound like Neil Dutta. Get on with it, this Federal Reserve.
I think a lot of people are on the same page as Neil Dutta. Neil Dutta has poured freezing cold water over this idea that if you go 50, you're signaling something really bad. What does the Federal Reserve know that we don't? He does not approve of that message at all.
I love what he was saying. If you really believe that, you should not cut at all and give ultimate confidence to the rest of markets. I mean, he doesn't believe that. And I would argue, I don't know that the market believes it either, because just we got the hint of the idea of the market coalescing around 25 basis points and then equity selling off. And that I thought was a really interesting knee-jerk move. Arguably, it's just algos doing algos, but at the same time, how much does that really support the fact that this market is looking for bigger moves?
For the first time in a long time, we have a live meeting to look forward to. Equity futures on the S&P positive by 0.2%. We gave you a snapshot of the bond market rally. 10-year yields are lower by 2 or 3 basis points to 365.32. The lineup this hour looks like this. Steve Auth of Federated on why the Fed needs to cut by 50. Sharon Miller of Bank of America on how small businesses are preparing for rate reductions. And Vishy Tirupattur of Morgan Stanley looking for markets to dip and then rip. We begin with our top story, looking ahead to next week's Fed decision with the call to go 50 or 25 basis points still finely balanced. Steve Auth of Federated Hermes writing they need to cut by 50 next week, but probably won't. If they don't, the next 6 weeks of data will likely push them to do so in November. And for sure, we're now entering a prolonged cutting cycle. Steve joins us for more. Steve, it has been too long, my friend. It's good to see you.
Likewise, John.
Thanks for coming in, sir. Let's talk about your call. Massive week for tech this week. Big tech, the Nasdaq 100 up by around about 5%. You like the small caps more, I understand from your research. Walk us through why.
We think the whole groundwork of this bull market that we've been in tech is shifting underneath our feet here. If you look at, I call it the 5 big things. Number one, you've got the Fed entering a cutting cycle. We've been in a hiking cycle. The economy is clearly softening. The labor market is softening up. It had been tight. Inflation has come way down. We're closing in on the Fed's target, which I think is 2.5. The yield curve is reinverting. This is huge for what works in the market. We can go into that if you like, but that is very big, and that's happening under our feet. The yen carry trade is over and is reversing, and it didn't happen in one day. It is going to unwind over several months. That was very supportive of tech. The relative earnings growth of the tech sector versus everything else is reversing. So you add all that up, all the factors that have lied underneath this bull market in, say, the new economy, the tech stocks, are underlying. And you've got this election coming, and that potentially, well, we know if nothing happens that rates are, taxes are going higher, and probably the regulatory regime is going to get even more difficult. We'll see. It depends on who wins the election.
3 things to unpack. The big tech call, things reversing, the yield curve, and then we get to the politics. Can we start with number 2 and the yield curve? Fed funds right now is at 550. The 2 years at 360. Mike Wilson of Morgan Stanley was on the program earlier this week and said, unless that spread closes, either with the Federal Reserve getting aggressive or the labour market data coming in much better than anticipated and the 2-year yield climbing again, that this stock market's going to struggle until we reconcile and resolve those differences. Do you not agree with that?
So I don't always agree with Mike, and he tends to lean bearish. And as you know, I tend to lean bullish, but I kind of agree with Mike. Yeah, we are in a difficult environment here because the Fed, as usual, this Fed is behind the curve. They were behind the curve. I mean, we were out there in 21 with others saying they got to get going. They were way behind the curve. They waited a year. They had a lurch at that point, 75, 50. And now they're in the same position. They're looking at everything with a rear view mirror. The inflation numbers are already at where they need to be. The labor market is really soft right now. The manufacturing sector is technically in a recession. The China economy is in a recession. Europe is probably close to that, or whatever you want to call it. So the Fed is way behind the curve, and they're probably going to do 20. I agree with Neil, by the way. The market isn't this stupid. The market knows the data. They're not going to be shocked if the Fed does the right thing. I disagree with that, but they're not. I don't think they will. I think this Fed tends to move slow. They're watching with a rearview mirror, but by November it's going to be obvious that they should have cut, and they'll probably do 50 in November. We're going to get to. I keep asking my bond people, where are we getting to? We're getting to probably a Fed funds rate of 2.5 to 3 on this cycle. So we have a lot of cuts in front of us. The 10-year is about where we're going to get. If the inflation rate stabilizes at 2.5 and you're back to having a 1.5% risk premium, which bond investors need, both because of Lisa's concerns about the fiscal, but also because, they've just figured out you can lose 20% in bonds, which, it was assumed you couldn't, back in 22. So the risk premium's back. That puts you at 4, 3.5. I mean, we're kind of there on the 10-year. So that's the inversion, because what's going to happen here is the short rate is now coming down. And instead of being the short rate, 100 basis points above the long rate, it's going to be back to 100, 150 below the long rate. That changes what works in the market. So the tech stocks, they don't need financing, right? They're cash flow generators. Everybody knows that story. It's the old economy that finance themselves short, the asset-heavy businesses. They've been getting pummeled by these high financing rates. The housing market's been pummeled. The auto market, we saw this week, Ally having trouble. So when rates come down, it's going to really help the old economy stocks. That's why we're calling for this great rotation, if you will.
We've been trying to wrap our heads around the idea of betting on the recovery before we have the dip. And that's sort of what the likes of yourself and other people who believe in the Great Rotation are basically calling for, that you should go into the areas that will benefit from the remedy to a problem that hasn't been fully revealed. How do you reconcile that?
Well, okay, Lisa, the Great Rotation actually is into value, right, and small cap. Half of value is defensive. So there's a little bit of diversification in this call. Like our dividend fund, as an example, is up 18% year to date. And it's all happened since this rotation started at the beginning of July, literally. So there is some defense in there. But you're right. That's why we put out that piece earlier this week about the enter the two R's. What we're starting to worry about, given how the Fed is behaving so slowly, that they could put us in a recession, not a rocky landing. We've been talking about rocky landing. And that hurts the cyclical call, which is in the value rotation. So it's kind of either a recession or a rotation. We're still on the rotation, but you're fair to bring that up. That is sort of the issue right now.
What would be the tipping point? What would you have to see to say that maybe move away from the little r of rotation to the recession call, especially if the Fed only moves by 25 basis points on Wednesday, and then you start to see the data continue to weaken?
Well, I think they'll then do 50 in November. They have so much room to go. I think they can avert a recession, but I am nervous for sure, given how they're managing things. Now, they might surprise me and everybody else, not everybody else. The market's now almost getting to 50 next week. I think that would be a wonderful outcome. Then you'll see this rotation trade really rip, because that's a good thing.
Can we talk about the politics? How much is the small caps?
Love to talk about politics.
How much is the small caps trade also tied to potentially a Trump presidency?
Absolutely. So the politics helps the small caps, right? He's sort of old economy guy, if you think about it. Biden, Harris, new economy folks. So if you get a Trump sweep, which is not obvious here, but if you did, that would certainly add fuel to the fire, because he's going to cut regulation. Regulation disproportionately hurts the smaller companies because the compliance costs are the same, rather how big your revenue base is. So it's going to help the small cap trade. It's going to help the old economy. You're going to get more of a tax cut. That helps the old economy stocks. So yes, absolutely.
When you think about the tax cuts, you mentioned them earlier, TCJA expiring. You said that you can't really put any weight on those tax cuts coming back into play. Basically, we flip back up to higher rates. But Kamala Harris has also said she doesn't want to raise taxes on those making under $400,000, and she also is calling for 28%, which is higher than a rate in the 30s. So could you start baking in some of those scenarios as a base case, regardless of who wins? There are going to be some provisions.
Yes, that's right. I agree with that. Yeah, it's probably going to end up somewhere in between. But if on the small cap trade, most of those smaller companies are paying taxes based on high income tax brackets. They file as individuals. So she's for sure going to raise those taxes if she can. What the market doesn't fully grip here is that this is a tax hike that's on autopilot. It's usually the case that you go, well, I don't know who wins the election. You got to have the majority. Maybe they'll do a tax cut.
Oh, no, they expire.
Yeah, full stop, they all go up. And now we're negotiating which ones don't. She leans more towards, let them all go up. That'll be her trump card, if you pardon the pun. He leans on cutting. He obviously likes them where they are. So you guys are talking about this. Yeah. It looks like Montana is red, and probably you're in a divided government, but very tight margins. Someone at your show mentioned this earlier this morning. It's not clear, so I think that the market's going to have to digest that. It's not clear where that's heading.
Steve, it's good to see you.
Likewise.
Got to do this again soon. It's been too long, which I think is your fault. Steve Auth, the Federated Hermes. Steve, thank you, buddy. Equity futures on the S&P 500 up by 0.2%. Let's give an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Chinese authorities have banned PwC for 6 months and also levied a record fine of $62 million over lapses in its work auditing Evergrande. In March, China's securities regulator had said PwC approved Evergrande's accounts, even though the developer had inflated mainland revenues by nearly $80 billion from 2019 to 2020. PwC said its top executive in China will step down in the wake of the scandal. Shares of Adobe trying to find its footing, but down some 8% in the pre-market trade following the sales outlook that disappointed investors. Investors were eager to see that the software company, which is known for programs for creative professionals, can make money from its tools. Adobe has focused on implementing AI into features and products like Photoshop and Illustrator, but the broader software sector has been seen as vulnerable to startup rivals and taking businesses from traditional companies like Adobe. Gold at yet again another record high. The precious metal is on track for a weekly gain of almost 3%. The surge has been boosted by expectations around a widely expected decision from the Fed to cut next week. Gold buying from global central banks and strong haven demand also been helping the advance, alongside shorts getting squeezed. That also might have contributed to the metal's rise in value. And that's your brief, John.
Danny, thank you. 25.68 on gold. There has been one consistent tailwind, central bank gold buying. Danny mentioned it, big feature of this move over the past year.
And it's a structural shift. So when it begins, people forecast it to continue. And I'm thinking about China in particular, but also other countries that would like to diversify some of their FX reserves.
Another all-time high. Up next on the program, attempting to settle the debate about the debates.
I believe we owe it to the voters to have another debate.
We've done 2 debates, and because they were successful, there will be no third debate.
That conversation up next. Live from New York City this morning. Good morning. Live from New York City this morning. Good morning. Equities right now positive, just about by 0.1%. Just a couple of upgrades in the last 24 hours. Had one yesterday from Deutsche Bank. Binky Charter raising his S&P 500 forecast to 5750. And Lisa, just moments ago, we got another one.
Yeah, from Michael Purvis over at Tauback and Capital. Moving from the call that they had last December of 4,800 to 5,800. Again, we're talking about forecasts now of about 3 to 4% gains from here, from current levels. So this is a bit of a catch-up, but it highlights the sort of capitulation to the YOLO FOMO kind of moment that we're really in the equity market.
It's leaning bullish, going into a big Federal Reserve decision a week away. In the bond market, the rally continues or resumes. Yields down by 2 or 3 basis points. The 10-year 364.76. Under surveillance this morning, attempting to settle the debate about the debates.
Donald Trump and I had our first debate. I believe we owe it to the voters to have another debate.
She immediately called for a second debate, which means that she was like a prize fighter that lost a fight. We've done 2 debates, and because they were successful, there will be no third debate.
So here's the latest. Trump and Harris hitting the ground, running with a busy schedule of campaigning following their one and only debate. Trump holding rallies and fundraisers in Arizona, Nevada, and California, with Harris honing in on swing state voters with a return to Pennsylvania once again today. Joining us now is Bloomberg's Josh Wingrove. Josh, no debate or a debate? What's on the table at the moment?
My money is on no debate right now. Trump seems to have drawn a line in the sand. However, as we know with Trump, nothing is final. It can always change. You never know. This is, of course, a big flip. You talk about sort of YOLO and FOMO. Trump was going anytime, any place with Biden. He wanted like a million debates, it felt like back then, just a few months ago. Of course, the first one set in motion Biden's exit from the race and brought in Harris. I think, the results of this, pundits are saying that Harris won it. We're waiting to see a lot of polls to see if voters agree. But right now it's Harris sort of begging Trump. So the tables have flipped. Doesn't look like we're going to get that. We will, of course, get that VP debate. So that's at least something for those, anxious for their fix on debate.
Josh, not to go into full-on scenario analysis, but if Kamala Harris, because you know these 2 individuals, if Kamala Harris came out and said, I'm willing to do a debate on Fox News, would then Trump show up?
It's a good question, because Trump yesterday did float Fox, and he floated NBC as options. Fox, of course, much more friendly to conservatives, typically extremely friendly in certain corners of Fox News. So Harris would have a calculus to make. She has not paid a lot of interest in the past to his previous offers to do Fox. Of course, his September 4th town hall that he did with Sean Hannity was initially unilaterally announced by Trump as a debate, and the Harris campaign sort of laughed it off as not a serious proposal. So if she was to say that, I think Trump would consider it because he thinks it would be friendly territory. However, she's shown no interest in it until now.
So, Josh, let's talk about where Kamala Harris is going. Pennsylvania. She continuously goes to Pennsylvania. So I read that they don't think they're winning that state right now. Is that accurate?
Pennsylvania looks like it's increasingly the ball game. The polls look really good for them in Wisconsin and Michigan. And the question is, how do you get those other 19 electoral college votes? Well, magic number, Pennsylvania has 19. So to win, she either needs Pennsylvania or she needs some combination of other states. Nevada plus either North Carolina or Georgia would get her there. Those are, of course, traditionally less blue states, although some polling has her competitive or even leading recently in North Carolina, for instance. You're going to see both of them in Pennsylvania all the time. And the question here, we've been talking a lot about what Harris has done since Biden left, right? A lot of the polls are up. The fundraising is way up. She's, more enthusiasm among certain blocks of voters. Joe Biden was from Pennsylvania. This is a state where the other side of that coin could come into play. Does him leaving the ticket, even with all the concerns about his age and his debate performance, impact things, in particular Northeast Pennsylvania, where he's from? Or can Harris put together the coalition that has won there in the past by driving turnout in Philadelphia, in its suburbs, and kind of holding the line throughout much of rural Pennsylvania, which skews, more Republican, a lot whiter, that kind of thing. So we're going to see them both in Pennsylvania all the time. And of course, that is putting a lot of eyes on the issues in Pennsylvania, including that U.S. Steel deal that we've been talking so much about.
There's a question around how much Kamala Harris is actually playing catch up after not selecting Josh Shapiro as her number two. Is that part of how you read some of the tours of Pennsylvania?
Yeah, it's the big question. I mean, her picking Walz is a bid that he can have broader impact in broader states rather than picking one guy that she would want to deliver one state. Now, Harris' team seems delighted with Walz. I don't want to leave any impression that they're sitting here with second thoughts. But hanging over this all is if they lose Pennsylvania and can't fill it in with one of those other scenarios like North Carolina and Georgia, then the Monday morning quarterback question after the election will be, could Shapiro have won this for them? And of course, that will tee up a lot of questions leading into 2028 about whether Governor Shapiro will run and if he'll be a top-tier candidate. Of course, he would be a very high-tier candidate if he did decide to seek the nomination in that scenario. So it's just everything, so much attention on Pennsylvania always. It just feels like more and more so. But things can change so much. Of course, 6 months ago, the war in Gaza, was the Israel-Hamas war, was impacting things in Michigan in particular. Now Michigan is consistently looking like it's in pretty good shape for the Democrats. Of course, no one knows entirely. So things can change really quickly. But we only have, 53 days to the election.
Can things change very quickly for Nippon Steel as soon as the election's over?
Yeah. If they get an extension, this is the big thing. The timeline is the big question for them right now. There was a big meeting this week. Maury, the vice president, executive vice president who's been handling this, flew to Washington for meetings, and people have been reading the tea leaves on this. And right now, there are not a lot of tea leaves to read. But the question is, Joe Biden has pledged to kill it. Our reporting and the reporting of others is that he plans to block it once it reaches his desk. As of Wednesday, it had not reached his desk. We haven't had an update since then. The question is whether an extension will push it, because otherwise people think, analysts think, people watching this closely think that deadline is coming up pretty quick before the election. So the choice it seems here is, does Biden have it hit his desk before the election and make a decision before the election, or is an extension granted and this drags on past the election, and then it's a different environment, obviously. I should note Harris, of course, is echoing Biden's position, which is they want U.S. Steel to remain domestically owned.
Yeah.
They've not been swayed by the proxy board that Nippon Steel has offered. Trump has just outright pledged to block it.
It would be nice if we had a sequence of questions on that in the debate on Tuesday night, but we didn't, Josh, and maybe we won't get another debate again. Josh, I've got to ask this. If Harris loves debate so much now, why does she still seemingly hate interviews?
That's a good question. I mean, I'm ready any time, any place, man.
I feel the same way.
Yeah, good. I'll put in the word. They are going to do more. They announced yesterday, in particular, either constituency or local media in battleground states. She's also going to go talk to the National Association of Black Journalists next week. Remember, there was some to and fro about that a month or two ago, and Trump went, and it was, let's say, an explosive interview that caused a lot of head scratching. So she's starting to open the aperture a little bit. We'll see how far that leads. Right now, it's about 3 or so, if memory serves, interviews. She's done 1 national interview. It's not a lot.
Not a lot at all. Josh, thank you, sir. Josh Wingrove there of Bloomberg on the latest. Some might say it's nothing. It's nothing, really. One interview, it's pretty pathetic.
You ought to be getting your message out and answer questions, especially if they weren't necessarily answered during the debate.
Caveat, one interview with a human shield of the with Governor Walz.
I know.
That's not fair. There really needs to be a one-on-one interview.
Sharon Miller of Bank of America up next, and certainly not on this. 2 hours away from the opening bell, stocks are positive by 0.2% on a 4-day winning streak on the S&P 500. This could be day 5, up by 0.2%. The worst week of the year feels like a year ago, and it was last week on the S&P 500. This is the bounce back this week, heading towards a week of gains on the S&P 500 and potentially on the Nasdaq 100. Lisa, the best week of gains of the year so far.
Driven by NVIDIA, right now we are about 1% away from the all-time highs in the S&P 500 with a series of upgrades from the likes of Binky Chadha over at Deutsche Bank, as well as Michael Purvis over at Talbot and Capital. They're playing catch-up with a market that is now being supported by both the soft landing and a Federal Reserve expected to do what it can, to do whatever it takes to support the sense of a labor market that's resilient.
This bond market has a strong bid once again this morning. Across the curve, the 2-year out to the 10-year, yields lower by anywhere from 5 to 3 basis points. 5 at the front end, down 3 on the longer end, on a 10-year at 365, on a 2-year at 359. How quickly the conversation changes. A couple of articles here at Bloomberg, at the Journal, at the FT, quoting some former Fed officials, teeing up the prospect of a 50 basis point cut, and the market saying, oh, don't want to be on the wrong side of that.
What that shows to me is just how balanced, I mean, I hate using the sort of language of du jour, but how finely balanced the market feels like this argument actually is, and how people don't understand what the Fed's reaction function actually is in terms of trying to get ahead of some sort of weakening that has yet to be seen, or whether they are data dependent in the sense that they would like to see that weakness first. And that's really the ultimate question. You heard Steve Auth there saying, look, if they go 50, we'll be grateful. If they go 25, well, they have to signal that they've got a lot more down the pike.
For me, it's not just about the 25 versus the 50. And I think for all of us, it's about the message in the news conference. You can go 25 and achieve the same thing as you would have done going 50 by being very dovish with the forecast and the dot plot, and being very dovish in the forward guidance as well, by saying this is the first in a string of interest rate cuts. This is where we think neutral is. This is the beginning of that journey back towards neutral, and lean heavily on that kind of guidance. I think the most hawkish thing they could do next week, if you heard the kind of Chairman Powell that we heard in Sintra, Portugal at the start of summer, and you don't hear the kind of Chairman Powell that we heard in Jackson Hole at the end of summer, then you've got problems. Because in Sintra, Portugal, only around June, July was it, he was coming out and saying things like, the labour market's strong, and that gives us time, and we can be patient to get this right. That was basically the communication coming out of the Federal Reserve. If you say things like that next week on Wednesday, when this market's very, very focused on the other side of the mandate, that would be a very hawkish 25.
Basically, that means a 25 basis point cut would come with a pretty significant equity sell-off, especially if you take a look even deeper into the statement of economic projections. They start to right-size their unemployment rate at the end of the year to closer to where we are right now. On the flip side, a very dovish central bank would be one. A dovish 25 basis point would be one that was signaling another 100 basis points of rate cuts, which could happen later this year. So you just really are correct in saying the details matter.
It's a 3-part act. It's not just the 25 or 50 that you'll see in the statement. It's the guidance you get in the forecasts, if they call that guidance. Maybe they won't. And it's the guidance you get in the news conference with Chairman Powell afterwards. There's a lot to get through next Wednesday. In the FX market, the dollar's a bit weaker today against the bulk of G10 off the back of that move in the bond market. The 2-year yield is lower. That means you've got a weaker dollar against the euro, 110.86, particularly against the Japanese yen, 140.84 on dollar yen right now. We're negative by 0.7%. Under surveillance this morning, Bloomberg learning the US and UK are considering lifting restrictions on Ukraine's use of longer-range Western missiles to strike deep inside Russia. Russian President Vladimir Putin warning against the move, saying the decision would be considered an act of war.
So basically what they're discussing is actually using Ukraine deploying British cruise missiles, but they would have to use the U.S. navigational data to use those missiles. And then Putin come out and says, well, if you're even using NATO navigation, that is an attack from NATO on Russian soil. This has been a debate for months. And I remember at the NATO conference, Biden was asked about this, and I just gotten back from Ukraine, and you really heard the Ukrainians pushing for this. And Biden said no, because if they have this ability to hit the Kremlin, we couldn't allow something like that. Say they go to Moscow. And the Ukrainians say, we're not trying to hit anything besides Russian facilities where their jets are taking off to hit Ukrainian soil. It's a big debate, but potentially we will see some movement on this.
It's one to watch in the next few days, that's for sure. Let's turn to the latest out of China. Set to raise the retirement age for the first time since 1978, the country's top lawmakers endorsing a plan to raise the man's retirement age from 60 to 63, while the age for women will raise from 50 and 55, Lisa, to 55 and 58.
What do you do if you've got a population that's aging much faster than you're procreating?
Don't let them retire.
Exactly. Basically work forever and expect to work forever. I mean, shockingly, those ages are pretty young. In the U.S., I think it's something like 75 years old.
I thought the same thing.
I mean, I was thinking to myself, they're just playing catch up. And at what point are we all going to be working until we're 95 with the help of, AI robots in our heads that can kind of make sure that we're cognizant?
Not many politicians in the West want to deliver that message, do they?
No.
Even though their cycle is 4 years.
Yeah, I mean, basically this idea of Social Security, you can't start paying until later on, is something that we've heard just briefly introduced, and that was political dynamite. That was not exactly what people wanted to see.
Well, Nikki Haley told Joe Matthew and myself that she wanted to raise the retirement age. She basically just said where we are right now is way too young. We need to shore up Social Security. And guess what? That clip was then turned into a Trump advertisement in Iowa to remind people why you should be voting for the former president. And then guess what? Stop talking about it.
Not popular at all. Let's turn to this report from the Wall Street Journal reporting Donald Trump's allies want to make another run at ending U.S. control of Freddie Mac and Fannie Mae if he's elected in November, saying former officials of the Trump administration, as well as bankers, have been discussing plans regarding the mortgage companies since the spring. That's the latest on that report from the Wall Street Journal. Elsewhere, Bank of America's business owner report showing cautious optimism from small and mid-sized businesses as the Fed prepares to cut interest rates. Sharon Miller of Bank of America writing, rate cuts will reduce the cost of debt servicing on floating rate credit facilities. This easing of the expense environment may create cash flow capacity for expansion or investment opportunities. We're lucky this morning that Sharon gets to join us on this program. Sharon, welcome to this program. I just want to start with this one. The amount of insight that you and the team have across 1 in every 3 small businesses in America. We're worried about stress starting to build, weakness starting to materialize. What are you seeing in the businesses that you cover at the moment?
Well, you're right. We cover 3.4 million small and mid-sized businesses in the U.S., and we are the #1 lender to small business across the U.S. And so we do have a lot of insight into what's happening. In our most recent survey that we did with business owners in the spring, we found cautious optimism from our clients. And so they do expect their revenues to increase over the next 12 months. And we know that debt servicing, as you said in the opening here, will be reduced because we do expect that rates will be cut, at least our economists do here at Bank of America, 25 basis points in the next 5 Fed meetings.
So, Sharon, are you saying they've got the confidence, the expansion plans are ready, they're just waiting for small reductions from the Federal Reserve over the next few quarters?
They are, and we still see demand in the marketplace now. So I'm not saying that they're waiting entirely. There is good growth across the small and mid-sized company sectors, but they are watching that. And certainly as we see rates come down, that will improve their cash flow and certainly consumer demand.
Sharon, I got to say, I was reading this report and I was shocked, the recent report that you put out. I was kind of shocked that actually we saw such sanguine sentiment that people were expecting to continue to hire, that they were continuing to expand. They had positive outlook for their businesses. How do you reconcile that with some of the rhetoric that we hear every single day? This is an economy that's on the razor edge of turning negative.
You know, I think with small and mid-sized companies, so we bank clients in the business banking space from startup to 50 million in revenues. And so when you have a smaller company, you're certainly more nimble. You're able to really, think about your business, your growth, and you can pivot easily. Bigger corporations may have more, of a hard time doing that. And so that is a competitive advantage of small to mid-sized companies. And we see that come through in the data and just in our conversations that we're having every day across the desk from these clients.
What I thought also was striking was in the market, it seems like inflation is no longer a significant concern. We heard just a couple of days ago from Mike Wilson over at Morgan Stanley that it's dead. Essentially, inflation is no longer an issue when it comes to what you're seeing in bonds. Nonetheless, 68% of small business owners say they've raised their prices over the past 12 months. And on average, they've raised prices by 12%. They're talking about inflation as a more pressing concern than many other things that we talk about every day. How do you understand whether this is really a small business issue or whether maybe we're not giving enough credence to just how much ongoing inflationary pressure there actually is?
Well, there is ongoing inflationary pressure. It is a sticky issue. And so we continue to hear that. That is the number one concern of small and mid-sized companies. And so you have seen price increases brought along because of all the pressure there. So I do see it as a concern. We hear it from our business owners. And we do feel that as we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
Sharon, given that pricing pressure, how difficult is it for these small companies to keep up with the bigger players?
Well, I think that there is some difficulty in keeping up with the bigger players, but I would say that they also have a competitive advantage. And so as supply chains have improved and as businesses have expanded, and certainly they've gone more online, gone more digital, they have more reach and scale than they might have had before the pandemic. And so what we are seeing are expansion plans from small and mid-sized companies, and they are competing. And certainly, they benefit from the downstream impact as well from larger corporations.
We're talking about inflation. We're talking about the fact that they're preparing for these rate cuts. When you talk to clients, what is their number one concern right now in this economy?
Their number one concern is inflation. And then right next to that is hiring and making sure that they have the right skilled labor, the right employees to go into their business to work. And so those are the concerns that we hear every day. We're also in an election year, so you do hear that as well. But we hear that with every election cycle. We've been doing this report for the last 10 years. And so in each election cycle, we see, concerns. Once the election is over, no matter who wins, no matter what party, that there's certainty, and so people can move forward. And so that's what we're hearing this cycle as well. And, I anticipate after November, there'll be certainty and people will continue with their plans.
Sharon, talk to us a little bit about how things have changed since March of last year, given all the banking stress in this country and some of the banking failures as well. How some of your clients have changed the way they do business with you, whether you've managed to attract a lot more small businesses over the last 12 months worried about where they place that cash and they want to put it with a bigger institution like Bank of America. Sharon, how much has changed?
Well, I think, listen, we are the number one small business bank in the U.S., and we're very proud of that. We have been for the last 4 years plus. And so, we continue to stand by our clients in good times and bad. And certainly, we every day we work to attract new clients and to retain the clients we have, because this is our mission. This is where communities meet business, and that is what we do at Bank of America. So we want to be sure that we are there for our clients. We have the capabilities they need, whether it's to transact internationally, to be able to, have expansion in their business, to get a loan, to provide payments for merchants. So all of those different areas, we are able to help our clients. And so we want to make sure that we're there for them, whether it be our online tools and capabilities to manage their cash flow. So we're investing in the business based on what we hear from clients and what they need.
Well, we were thankful that you managed to make some time for us this morning, and we appreciate it. Sharon, thanks for joining the programme. Thank you. Sharon Miller there of Bank of America. On the latest insight into the small business situation across this country, biggest banker of small businesses, and I think we need to get into this. I was surprised to see what you were surprised to see, which essentially is there's still confidence there that we've got this expansion plans ready to go, just waiting for a reduction of 2 or 3 or 4 in interest rates, and then we can start making a move. And then inflation is still the biggest concern for corporate America.
Basically, this flew in the face of a lot of the assumptions of a lot of people in the market in terms of the broader economy and the broader S&P 500. Question of how different this particular sector is from the rest of the universe. There were some nuggets in here, though. Yes, inflation, the number one concern. But when it comes to AI, I thought this was interesting, too. We all talk about AI adoption, how quickly it will be sort of rolled out. 37% of small business owners plan to use AI in 2024. Sounds like a lot. That's a 12 percentage point drop from last spring. So a question about the use case and whether it's actually getting diminished as time goes on.
That's a big stock market story as well, potentially for the next 12 months or so. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The Biden administration has moved ahead with major tariff hikes on imports from China. The tariffs include an 100% duty on EVs, 50% on solar cells, and 25% on materials like aluminum and steel. That, according to a U.S. trade representative. The tariffs will go into effect on September 27th. China has vowed retaliation against the actions, claiming the success of its EV industry comes from innovation, not unfair government support. Hedge fund Millennium Management is looking to raise between $7 and $10 billion of locked up client cash. It will do so by asking clients to make pledges that Millennium can tap over time. Like its peers, the hedge fund has been moving to make more stable capital that it is able to access for longer. ECB President Christine Lagarde said the central bank may consider another rate cut as soon as next month. She spoke in Budapest just a day after the ECB cut rates by a quarter point. Lagarde said that an October rate cut would be warranted if the economy suffers a major setback. Still, Lagarde indicated that policymakers will remain data dependent and are leading towards waiting until December for the next move. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the program, divided over rate cuts.
The market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
The conversation just around the corner, that decision a week away. Equities this morning positive by 0.1% on the S&P 500. Yields a little bit lower, down 2 basis points on a 10-year, 365 on a 2-year, down a little more than that. We're down 5 basis points at 359. Under surveillance this morning, divided over rate cuts.
With this lingering uncertainty, unevenness in terms of the disinflationary trend, I think this underscores the Fed's need to remain on a very patient, tempered approach as we do embark on this policy pathway back towards neutral. Now, the market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table.
And then the market reintroduced it this morning. So here's the latest. Investors questioning whether the Fed goes 25 or 50 at next week's meeting. Vishy Tirupattur of Morgan Stanley saying, although we're still looking for the Fed to start a series of 25 basis point cuts at the upcoming meeting, a 50 basis point cut is not off the table because our read of the jobs report sees heightened risks that the slowdown will be more than our baseline assumes. Vishy's with us around the table. Vishy, good morning, sir.
Good morning.
You've been around the world seeing clients, I'm sure. Can we just start with this massive bid and the bias to buy in this bond market for both sovereigns and corporates alike, and not just in the US, worldwide? What's behind that at the moment?
I think there is a general expectation. Two things are behind them. One is the relative value proposition between stocks and bonds. And the second is the expectation that we are heading to significant amount of rate cuts. And it's global. It's in the US, it's in ECB. So we expect to see more rate. The path ahead is for a lot more rate cuts. And I think that this basically makes rate cuts are happening at a time when the economy, especially in the US, is not in a recession. Rate cuts are happening when the economy is clearly decelerating, but still, around 2% growth. And that's actually looks pretty good for credit. And I think main focus is really coming from, the path ahead for lower rates, and economy looks good, credit looks good.
Let's sit on credit, 2 words, and they're yours, dip, rip. Why the dip before this rip? What are you looking for in credit?
I think it's a little bit of technicals in this. The technicals here come from, seasonally, September is not a great month. There's some uncertainty associated with that. And as the markets are resolving the 25 or 50, exactly what the Fed resolves it eventually for us, I think we might see the relative value between credit, as in corporate credit, and other parts of credit, whether you look at CMBS or CLO or other parts of other spread products, look relatively cheap at this point. But if you look ahead further, once it looks like a pretty good path ahead for credit overall.
Torsten Slok this morning putting out a note talking about how there's a lot of foreign buying of credit in particular. To just build on what John was asking about, where is the cash coming from to buy all these bonds? We were talking to Mohamed El-Erian yesterday, and he was saying this is the cash on the sidelines kind of coming back in, away from money markets, into credit, into duration. Is that how you see it?
I think it's, the money sitting in money markets. I think the idea that there'll be money market will flow in one big swoop, I think that's misleading. It will take time, but I think when it does move, it will move more towards high quality fixed income rather than jumping into stocks. So yes, there is some of that. There's also what I would consider, especially in the US, there is an insurance company bid that's going on. So insurance companies are selling these annuity products, which are effectively fixed rate products that sit on the liabilities sit on the balance sheet, the assets sit on the balance sheets of insurance companies. They need a treasuries plus 200, 300 type of product. And that bid is become insatiable. And that's, the sales of the single premium deferred annuity products have more than tripled in the last few years. And that's a big positive technical.
Yeah. A lot of the private investment firms have been offering these. This is the hottest growing area. We've talked to Apollo about that. I am curious, though, just from a broader perspective, how much what we're seeing in credit, what we're seeing in duration, is a technical trade more than, say, a macroeconomic call? And I ask that because we were just talking to Bank of America about how inflation is still the preeminent concern for a lot of small businesses. We see in the data this week, CPI, PPA, okay, great, it didn't surge to record highs, but at the same time, on the margins, just creeping up a little bit or upside surprise in certain places. How do you reconcile the macro signals versus the reality right now?
Absolutely. I think there's a positive technical, no doubt. But the fundamental story for credit is really strong. If you think that the macro story, as I was just saying earlier, Fed is cutting at a time when the growth is still pretty decent, 2% growth. And this decelerating but not falling off the cliff, when Fed cutting at the time of decelerating but not falling off the cliff, is actually very constructive for credit. If you in fact step back and look at, we've looked at data from 1948 to now, because we have data, because I'm a geek. I think basically what we see is that if you look at quarterly returns, excess returns in credit, and you map that with the GDP growth rate during the period, credit does best when economy is neither too hot nor too cold. The 1 to 2% GDP growth rate is the context in which credit does the best. And we are precisely in that sweet spot.
You're maintaining a short dollar yen.
Correct.
Do you think the carry trade is over?
It's very difficult to say it's over. I mean, it's because it's very difficult to assess how big it is. I don't know if it's over or not. But we think that the yen is the direction of yen is more driven by the direction of the U.S. rates, particularly the 2-year Treasury. So we expect that the 2-year Treasury will drive, and that's we do expect to see yen drop further.
And then also the BOJ. Do you expect them to actually hike?
Our expectation, our base case expectation, is that of a 25 basis point hike next year in January from the BOJ. Certainly, the market is assigning somewhat higher, somewhat higher rate possibility that we'll see more than that. So this, what I would say, policy divergence, which is BOJ hiking while rest of the world cutting, that actually makes this. Regardless of why it is happening, we think dollar yen is going lower.
I hope we stop talking about the carry trade for a bunch of reasons. I hope we talk a lot more about the massive dollar long that's accumulated over the last few years, underpinned by US exceptionalism, particularly in the equity market, underpinned by the fact that this is where the income has been, the yield with rates of 550 in the United States versus what's available and the direction of travel in places like China or in Japan. And whether that dollar long needs to be unwound. And what sparks that? Is it 50 basis points, 100 basis points of the Federal Reserve? I think we can park the carry trade language. The idea that there's this bunch of hedge funds that are doing something in Japan that influences something in America. There's something much bigger going on that's accumulated over the last few years. How vulnerable are we to a big unwind of that?
I don't think we are that vulnerable. I mean, we don't think we are in a point where investments, dollar investments, will shift dramatically away. We are still. The American exceptionalism stands still. It very much, the thesis very much is there. We still have growth differential, meaningful growth differential. We are decelerating, but the rest of the world is decelerating much more. If you look at China, much clearly the prospects don't look that good. And then you have the idea that there will be cuts, but the rest of the world is cutting as well.
Yep.
So you put all those things together, we think the dollar as a reserve currency holds, and I don't think there's we periodically hear of this. Dollar is no longer a reserve currency. We completely reject that argument.
Sticking with it, Vishy. It's good to see you, sir. Vishy Tirupattur there of Morgan Stanley. Rebalancing growth differentials is going to be harder than some people make out, Bramo.
That's the reason why people are looking for that carry trade boogeyman.
The third hour of Bloomberg Surveillance. Up next.
The market overall is a little bit vulnerable.
I think there is significant downside risk here, recession or no recession.
Recessions come from policy errors.
Markets are underweighting the impact of those pro-growth policies in the beginning of the year.
Definitely balanced risks looking forward into the next multiple years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We're almost there. The weekend hours away. The third hour of Bloomberg Surveillance starts right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, we add some weight to this rally on the S&P 500. 4-day winning streak. We're up another 0.2%, leaving behind the worst week of the year so far on the S&P and adding some weight to the best week of the year on the Nasdaq 100. Nasdaq 100 futures look like this. Positive by 0.02%. On a Russell, that's where your outperformance is. The small cap's up by 1 full percentage point. Off the back of this move in the bond market, check out fixed income. The front end of the curve, the 2-year yield is down by 4 basis points, 359.91. Let's just round it up and call it 360. Looking ahead to the Federal Reserve decision on Wednesday, 25 or 50. The data this week gave you a lean towards 25. PPE, CPI a little bit hotter. Jobless claims yesterday coming out just a tiny bit higher, but no drama. Still pretty subdued over the last month or so. Take the totality of the data, 25. Then this happens. The 13th member of the FOMC writes an article in the Wall Street Journal. And all of a sudden, we start to query whether the bias is to go 50 and not 25.
There was an article that came out around 1 p.m. yesterday in the Wall Street Journal that talked about the two-sided debate around 25 or 50. Some officials have suggested they would rather speed up the pace once the economy looks like it is weakening further. Alternatively, and this is what caught people's attention, some may expect that if they do see weakness coming up, they ought to make that move now when rates are farthest from their ultimate destination. All of a sudden, just like that, 47% chance that you're going to get a 50 basis point rate cut. A real question here about whether this is guidance or whether this is just a reflection of the debate that's being had in markets right now.
I think it is highly problematic. I've said it on this program before, and I will say it again. It is very difficult to get a read on certain articles by certain authors on whether this is actually coming from the FOMC or coming from the author and the people they cite directly. And when you don't know, I think the Federal Reserve has a problem. And the Federal Reserve has a problem that's accumulated over a long, long time. It doesn't just go back to 2022, but let's take 2022 as an example. We were expecting a 50 basis point hike. We got UMich sentiment that week, that Friday, I think, before that Federal Reserve decision, and inflation expectations clipped higher. And all of a sudden we get an article, sourced directly almost from the Federal Reserve, leaning towards 75. Ever since then, for this whole cycle, under this leadership, we've waited not just for Fed speak, not just for economic data, but for an article from the Wall Street Journal to give us a steer as to what's going to happen on the Wednesday. I don't think anyone at the Federal Reserve thinks that that's how you should run monetary policy, and I certainly would agree with them this morning.
There is a real question right now, again, and I think you're correct, in terms of is this a steer or not? And it was interesting to hear Jim Reed over at Deutsche Bank saying that this echoes, as you said, what happened over in 2022, where there were questions around how much they would hike rates. And this article put together the 75 basis points that they then came through with. A real question here, and Jim Bianco pushing back this morning and said this is the opposite because it introduces that uncertainty. We don't know whether this is a steer or just simply a reflection of a debate that's being had in markets. Either way, is this the way forward guidance is being operated?
I want to be super clear. It's not the author's fault. I think the author is the envy of the world in financial markets when it comes to financial journalism with the access he has in the Federal Reserve. It's not the author's fault. This is the Federal Reserve's problem.
Yes.
And I think it is a problem, a big one, going into a big meeting.
If you want to signal something, say it in a speech. If you want to steer the market directly. If you want to do it through second channels and it's not necessarily clear, then you might be giving a different steer, and you're giving people an outsized degree of power to influence the market and alternatively, potentially the Fed's power. You're right, because this is something that was traditionally what they did. And here we have a situation where it's introducing more uncertainty.
It's muddying the waters. They want transparency. And maybe a journalist can ask Jay Powell about this at the press conference. If you want to go to someone with credibility this morning, it's Dudley. The question is, why don't you just get started? That's what he said. It's basically up to Chairman Powell to see how much support he has for being more aggressive. I take Dudley's comments with a lot more weight in terms of potentially them leaning towards 50.
Bill's been making this argument for a while. Neil Data's been making this argument for a while. If you're offside, let's get a move on. And I think that the point that Neil Data made around interest rates is an important one too. If you go 25 instead of 50 because you're worried about the signal, why cut interest rates at all at this point? I think that's a perfect point, a valid one.
It is definitely highlighting the lunacy of some of these arguments. At the same time, you can imagine that if they cut by 50 basis points, maybe the market would extrapolate in 150 basis points of rate cuts, because why not cut by 50 basis points at every single meeting? Look, you can come into a lot of different scenarios. As you've mentioned, the Fed can do a lot with the messaging, with a statement of economic projection. So it's not just about this particular move, but going forward, where the balance of risks actually
Wednesday is a three-part act. You'll get the decision, you'll get the forecast, and you've got a big news conference as well with Chairman Powell. Equity futures on the S&P 500 firmer by 0.2% on the S&P. In the bond market was shaping up as follows. Yields are a little bit lower, down a basis point on a 10-year, 366. On a 2-year at the front end of the curve, we're down 3 basis points to about 360. And foreign exchange showing a little bit of dollar weakness against the euro. Euro dollar at 110.80, a little bit more against the yen. Dollar yen down by 0.6%, Lisa, this morning.
And really, it'll be a two-part act next week as well, given the fact that we have the Fed conference on Wednesday and then the Bank of Japan rate decision. How much are they going to lean on what happens with how dovish Jay Powell actually is to decide whether they need to hike or signal a hike, or whether they can just leave it be?
Coming up on this programme, Sinead Colton-Grant of BNY Wealth saying the S&P 500 can still climb into year-end. William Stein of Truist on the divergence among chip makers. And Troy Gayeski of FS Investments saying tech is one of the greatest growth stories in capital market history. ... because he's got things to say. So stay tuned. We begin with the big issue, the Nasdaq 100 heading towards its biggest weekly gain this year, going into the Federal Reserve meeting next week. Sinead Colton-Grant of BNY Wealth looking for the rally to continue. US exceptionalism continues. The rotation that started with a soft headline CPI print for June is a healthy broadening of the rally, bringing our year-end forecast for 2024 to 5,700. Sinead joins us now for more. Good morning, Sinead.
Good morning, Jonathan.
It's good to see you. So let's start with this call, because this week has been about big tech, not the breadth, not the broadening out, not about other sectors. In fact, at times, financials and energy have really struggled. Why is the bet beyond big tech?
Well, we're starting to see the beginning of the rate cutting cycle, as you were just speaking about. So whether we get 25 or 50, the point is that we're starting on the journey. So as we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly. One of the reasons why tech has done so well, setting aside the AI focus, it's been because of the amount of free cash flow that they've had, the fact that their earnings have been expanding so quickly. When we look ahead to the remainder of the year and also into 2025, so we're looking for earnings for the S&P for the full year to be between 245 and 255. And then higher again in 25, so 15% earnings growth in 25, getting us up to 280 to 290. So when you talked about 5,700, yes, that's right. That is the upper end of our range.
Okay.
So assuming we don't have a recession, that we do see a soft landing, you could even see markets slightly higher than that. And the other thing to remember is September is usually a tough month for markets. On average, markets fall about 1.2%. It's the broader market, the S&P, not the Nasdaq. But then you have almost a 3% rally in Q4. So looking at where we are now, that sets us up pretty nicely for 5,700.
Let's pick out a sector, the financials, the banks. It's been a really interesting week. JP Morgan's Dan Pimco came out and essentially said the analyst expectations around net interest income are too bright, too rosy. So everything's starting to come down. JP Morgan had a terrible day that day. That's based on the path for interest rates. Ally Financial came out and said the auto loan book wasn't great. That's based on credit deteriorating. What was your takeaway from the conferences this week, particularly the Barclays Global Financial Conference earlier this week?
Well, look, the path of rates is clearly important for net interest income. We are of the view that we probably see 25 next week. but undoubtedly, somewhere between 75 and 100 by the end of the year. What those two contrasting comments are focused on is the impact on the consumer, right? The reason why you're seeing some deteriorating credit quality is because the lower income cohort have been really feeling the pinch, not only from the higher rates, but also the cumulative effects of inflation. So at the margin, as we start to see rate cuts, that will relieve a little bit of that pressure. But when we look across various segments of the market, you've got the upper income cohort performing very well. They've got balance sheets that have expanded. Generally, their debt service cost hasn't really changed since 2019. So they've been insulated by 2.5–3% mortgage rates. But at the lower income cohort, when you start looking at, we focus on, our 2.5% CPI read year over year, the most recent one. But when you look at the cumulative impact and you start looking at individual segments, food, energy, et cetera, you're in the mid-20s for the cumulative impact over 4 years. You take all of that together, not surprising that on the auto loan side, you're starting to see some pressure.
When you put it together, it just is a sort of a contradictory signal that's hard for some of us to get our heads around, this idea that you could have a weakening economy, you could have a rotation towards some of the more economically sensitive stocks that are going to be susceptible to some of these shifts, the financials in particular. And you're projecting a gain of about 13% from here to 6,300 by the end of next year. What's going to lead that if you do have these questions around certain aspects of the cyclical market and you do have these concerns about the resilience, particularly of a whole cohort of consumers?
Well, first of all, by the time we get to the end of next year, we're probably going to have seen somewhere in the region of 150, 200 basis points of rate cuts. So that's automatically going to help with some of those more sensitive sectors. But let's think about the economy more broadly. And look, realistically, market participants, we can tell, have been finding it very hard to believe that we're going to see a soft landing. And you've seen that in the market reaction that we've had to softer data prints. When we look ahead to 2025, we think the economy continues to expand. So in addition to an upper end of 2 to 2.5% this year, we think we see a similar level of growth in the economy next year, which will underpin sectors more broadly. Now, if you look at one of the sectors that hasn't done well this year, relatively speaking, it's consumer discretionary. And as you start to see rate cuts, you'll probably see that start to do a little bit better. But broadly, when you look at earnings across the board, 2025 heading into 2026 is when you've got to start to see investment in AI impact productivity, impact earnings, and that's the other tailwind that we expect.
It's interesting, the sort of shifting story around AI, and that's actually something that's where I wanted to go. Can you get a 13% rally in the S&P 500 in the next 14 months or so without participation of some of the big tech stocks?
They're a huge component of the market. So, of course, if we expect the S&P to be at those levels, the tech sector is going to play a significant role there.
Sinead, we've got to leave it there. It's got to catch up. Appreciate your time, as always.
Thank you, Jonathan.
Thank you. Thank you so much. Sinead Colton Grant there of BNY on this market going into this big Federal Reserve decision next week. As we keep on saying, three-part act. We get a decision in that statement. We'll get some forecasts as well and a news conference with Chairman Powell shortly afterwards.
Which has leaned dovish consistently, and that's probably why Bill Dudley's comments got so much attention as well. Not only is he the former New York Fed, but he also is saying, can he bring the rest of the committee around to his view?
Is he the 13th member of the FOMC? Equity futures on the S&P 500. Don't worry, Bill, we know you're not. We're up by 0.2% on the S&P. Maybe you'd like to be. I don't know. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Strategists at Bank of America, led by Michael Hartnett, are expecting stock markets to trade sideways until more clarity on the U.S. labor market. He wrote that a clear direction for jobs will, quote, resolve the autumn ambiguity. Hartnett also noted that stock funds had their largest weekly outflow since April, with $6.1 billion exiting the asset class, citing EPFR data. Meanwhile, investors continue to pile into cash. The New York Times just out with a report that Miami Dolphins owner Stephen Ross is talking with PE funds looking to sell a stake in the team. Besides the Dolphins, the transaction would also include a stake in the Miami Grand Prix and the Hard Rock Stadium. In total, Ross is looking to sell as much as 15% stake in the assets. Firms in conversation include Arctos Partners with a valuation above $7 billion, according to the Times. Elsewhere for the Dolphins, week 2 of the NFL season is underway, and the Buffalo Bills are riding high after easily handling the Dolphins in South Florida. Concerns are high, though, for Dolphins QB Tua Tagovailoa after he left the game with a concussion after diving for a first down. That's his 3rd concussion in 4 years. And that's your brief, John.
Yeah, that's not great. That's not great at all. Danny, thanks for the update. Appreciate it. More from Danny in 30 minutes' time. Up next, the Morning Calls plus William Stein of Truist on the outlook for chips. That's just around the corner from New York. This is Bloomberg. Andrew Hollenhorst of Citi with this to say: 25 versus 50 remains a close call. Articles in the Financial Times and Wall Street Journal keep the prospect of a 50 basis point cut next week on the table in our base case. The Fed cuts 25 next week, followed by 50s in November and December. But he says the story's not over. Next week, weak enough retail sales on Tuesday could push the Fed to cut 50. I think we all just want to see the back of this meeting next Wednesday, don't we?
I couldn't agree more, considering the fact that we thought we were getting most of the economic data that was relevant this week. Now, retail sales is the new Michigan Sentiment Survey.
Let's see what we get. Let's turn to the bond market. Price action looks like this. Yields are coming in, down 2 basis points on a 10-year, 365.51. At the front end of the curve on a 2-year, down 4. It's a break of 360, just about. 359 Lisa at the front end of the curve, unlocking some dollar weakness on the margin again on the morning.
And this, to me, really does hinge very much with 25 or 50 and whether the market can extrapolate in an additional 100 basis points of rate cuts after that. Key question to me is just how much people are underweighting the possibility of the ECB actually saying, hold my beer, considering the fact that their economic outlook is negative and they did downgrade it further in the economic projections yesterday.
I keep saying this. If the Federal Reserve delivered the kind of guidance that the ECB do, can you imagine the kind of reaction? The growth profile in America is better than what we're seeing in Europe. Inflation is basically in line. Europe versus the United States, not quite apples for apples, but you know what I mean. And we've got an ECB saying, meeting by meeting, 25 now won't tell you anything about next time, a mystery. Let's see you next time. And the Federal Reserve, we're sitting here saying, oh, 50? What about next time? And the one after that? Show us a string, show me the dot plot. Talk to me about the destination. Where are we going?
If the Fed were going to do what Christine Lagarde did, you would see a massive sell-off in equities, led by those same small caps that might be the ones that get the biggest boost from the rate cuts right now.
Futures outperforming on the small caps this morning. Time for the morning calls. First up, JP Morgan cutting Moderna to underweight from neutral with a lower price target of 70, down from 88. The analyst saying quarterly results are not likely to surprise to the upside. Your second call from RBC, downgrading Halliburton to sector perform from outperform with a lower price of 37 from 44. The analyst citing disadvantages in a tepid commodity macro environment. And your third and final call, BNP Paribas downgrading Micron Technology by 2 notches to underperform and cutting its price target to a street low of 67. The analyst warning the stock will continue to underperform others in artificial intelligence. Divergence growing in the semiconductor space between the likes of Intel and Nvidia. A theme to watch. William Stein covers semis and AI for Truist, and William Stein joins us now for more. William, let's get to that. The divergence that you're expecting, that theme, can you just build it out for us a little bit more?
Sure. Well, we didn't write a note on this recently, but certainly we have a view that semis are in an upswing in aggregate, but the end markets and products are seeing very divergent trends, right? For at least a year, we've seen these broad-based end markets like industrial and automotive and those end markets sort of drag. And, I think for folks that are just looking at companies that serve those end markets, you might say we're in a downturn and maybe at the bottom. But meanwhile, those who are very focused on the AI-linked names, you're seeing tremendous growth. In aggregate, it means that we've actually been in an upturn in semis for about a year and a half already. And, growth is quite good, but it's very much a story of haves and have-nots, with the AI-focused companies led by NVIDIA doing very well and many of the others seeing fundamentals trough.
Well, I do wonder then what you make of the recent volatility in NVIDIA shares. We saw just a comment from Jensen Huang coming out and saying that people are feeling really anxious, nervous. There are emotional conversations about getting their deliveries. That was enough to boost the stock by more than 13% in just a couple of days. What do you think the signal is from the volatility in shares of such a massive stock?
Yeah, I think it's maybe an over discussion. I think that's the best way I could describe it. An over discussion by investors who are not sure and not perhaps long term enough in their thinking on the trends that are so powerful for this company. AI is one of two major trends that NVIDIA is experiencing. The other is a shift away from serial compute to parallel compute. That's a bit of a technical issue, but the big application there is AI. The demand is very strong. We think it's going to remain that way for some time. We think the return on investment opportunity for companies to build out these systems is very robust. And that's where the discussion tends to focus, right? Is, we're spending billions of dollars. Are we getting anything out of it? And are they all going to stop spending next year somehow? Our checks for some time have reinforced a view that 2025 is going to be a very strong growth year for NVIDIA, not just for these so-called GPU chips, this parallel compute for AI, but also the CPUs that NVIDIA is delivering into that market as well, this product called Grace. That's a big new opportunity for the company. We think that really ramps in 25 as well.
You can feel this anxiety, though, among a lot of investors. It's just been such the overperformer, the outperformer, the thing that's held up the entire U.S. equity market for a lot of this year, that surely it's got to change. And so we hear more and more investors talking about rotating their portfolios away from NVIDIA just to sort of diversify. How much can you push back and say, actually, even though it seems like we've priced in all of this growth, we haven't? How do you sort of reconcile some of the anxiety that you're feeling in when you speak to clients?
Yeah, I think the most straightforward thing to do is to ask investors to stop looking at the price chart and instead look at the PE chart. Someone said to me the other day that, look, the stock's exploded. Well, if that's exploded, earnings have, gone to Saturn, right? I mean, the earnings growth has been tremendous for this company. And so, what you've seen in the PE action, I know through most of last year, you were seeing PE contraction despite this massive run in the stock. And I think that's the thing that I would focus on is certainly there's growth embedded in the outlook for this company. But the PE multiple relative to the growth we're seeing is really nothing demanding.
Well said, William Stein. William, we've got to leave it there. It's good to catch up, as always. William Stein there of Truist on the latest for the semiconductors. Note just drops from Neil Dutter of Renmac. I believe in Jerome Powell. The case for 50 is strong, and so Neil is sticking with it. If there is a higher risk of rising unemployment than rising inflation, and the policy rate is well above neutral, a large upfront move makes sense. The high end of the central tendency for the range for neutral is 3.5%, and so a 50 basis point move would still keep policy in a restrictive setting. If the Fed is offside, maybe by as much of 100 basis points, it's time to get a move on. My words at the end there, but ultimately the sentiment's the same.
If they do that, I'm curious how much they're going to address the neutral rate, how much they really discuss the destination and whether their dot plot and the third part of the act or second part of the act of the economic projections when they come out, how much they elucidate the Fed's new framing of where they're going, because what we saw in Jackson Hole was not a lot of discussion about that, maybe 3.5%, maybe 3%, who knows, but there wasn't necessarily a focus as much on naming what that destination looked like.
Chairman Powell did something really clever in Jackson Hole, Wyoming. He set a threshold for the whole committee to be judged by. He set a threshold for them, which means they're sort of constrained. He basically said, and we all know what the words were, we do not want to see or welcome any further cooling in the labour market, right? So everyone's got to abide by that. So when they sit around the committee, when it comes to the middle of September, next week at the decision, they have to look back on the labour market data of the last few months and make a call. Have we seen a cooling in labour market conditions, yes or no? And is that desirable? And the answer to that is yes, we have, and no, it's not. So we should do something about it.
How much? And now that's the question. Right now, that's the reason why the debate is between 25 and 50. There's a question of whether this will spook the market. It seems like fewer people are mentioning that, actually. Fewer people are actually talking about the fact that this would actually be a negative signal to markets. And yet, you have to imagine that at some point, there's a question of whether it's too much weakening. I don't know. I'm personally thinking that when do you start worrying about inflation again?
That's your call? You think that's what gold's reflecting this morning?
Yeah, I do. I think that right now there is a feeling that this market might be baking in a overly complacent feeling about inflation at a time where small businesses are still saying that's their preeminent concern, and you're still seeing housing costs remain high.
New all-time high on gold again this morning. Up next on this program, Tiffany Wilding of Pimco, Troy Gayeski of FS Investments. From New York, this is Bloomberg. "60 minutes away from the opening bell, equity futures on the S&P 500 look a little something like this, just about positive by 0.2%. I tell you what, last week just feels like ancient history. The worst week of the year on the S&P 500, bouncing back and going towards a week of gains on the Nasdaq 100. Bramo, we're looking at the best weekly gain of the year so far, a move of 5%. People are sort of downplaying the importance of Nvidia and this big rotation that's going to take place. Jensen Huang, a few words, the CEO over at Nvidia, and you've had a major move on that stock this week.
People have been trying to move away from this and viewing it as healthy, and then they just can't get enough because at the end of the day, I mean, we just heard basically from Will Stein that what you see is their earnings are keeping up with their stock price that's surging so much. Question about whether the rotation will continue, though, in a more significant way, not necessarily with underperformance, but just outperformance of small caps if you do get that outsized rate cut.
Outperformance on the small caps this morning, the Russell up by about 1% on the Russell 2000. There's some of your index level movers. Let's get you some stock movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. Yeah, it seems as if we've moved off that buy the dip to incremental FOMO. 5 days ago, we started this show with this stock bid on the prospect of a deal between the unions and management. That unfolded overnight. 33,000 machine workers going on strike. 25% is the pay deal that's on the table. But here is the thing. This is a company burning through cash. So we've gone from the euphoria of Monday morning to the reality of that strike coming to bear. If they go out for the average strike, 50 days, you're looking at 3 to 3.5 in terms of the additional cash burn. They can't afford that on the credit outlook. So we started from the ecstasy to the agony of Boeing. Have a look at this. Oracle, if you really want to go beyond the Mag 7 and understand who is eating into the cloud pie, it is Oracle. Basically, this stock was up 14% to the close last night. We're now up 20% for the 5 days trade if we finish up 6.4% today. It's a vigorous guidance again from this company that they are making inroads in the cloud business. Guggenheim have a price target of $200 on the stock. So the momentum is with Oracle. Let's close it off with Adobe. What do you not want to hear from the guy that runs all the innovation around AI? And this is what has happened. The AI guidance here, use our AI. It's not about monetizing our AI. That is not what the market wants to hear. The market does not have the patience for get used to my AI. The market wants you to adopt, use, and monetize. And that is not what we heard from Adobe overnight. Morgan Stanley still stick with $660 on the books. Jefferies are still there at $700. So it's not the guidance in terms of profitability. It is the AI delivery story. Jonathan.
The language matters. Manus Cranny, thank you. Not a pretty chart on that stock this morning. A pretty chart for Nvidia. That name this week is up by almost 16%. That is a cool $400 billion of market cap added to that name this week. Isn't that amazing?
Well, if you said words matter, use, not necessarily adopt, anxiety by our clients, boom, 16% rally. That's what you see in Nvidia.
What a stellar run for that stock. That's the move on Nvidia. Let's talk about the moves we've got to see over the next week. A busy slate ahead with retail sales and a Fed decision next week. Tiffany Wilding of Pimco saying we are heading back to pre-pandemic conditions. Developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Tiffany joins us now for more. So, Tiffany, you've got to give us the answer. What did that conversation sound like at Pimco this past week?
Well, I think the bottom line for us is certainly interest rates are coming down. The Federal Reserve, I think, has also been very clear about that. Powell, when he spoke at Jackson Hole, I think acknowledged the fact that monetary policy now probably doesn't reflect the underlying conditions in the U.S. economy. And if you look at the labor markets, we don't think that the U.S. economy is in recession, but nevertheless, the recent loosening in labor markets just suggests that there is some possibility for overshooting on that side. And in that kind of vein, the Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path. In September, we're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here.
Tiffany, tell us where you think neutral is. If they revise the path down, what is the path to?
Yeah, I mean, I think that's a great question. So the Federal Reserve still believes it's between 2.5 and 3 on a nominal basis. And I think ultimately that's why they will get there, with not overnight. They're not going to move the policy rate there overnight because they're not exactly sure where it is. And when you're not sure, you want to just go slowly. Now, how slowly, I guess, is the question. And it's about balancing risks. You obviously don't want to take the economy into recession because your policy is too tight. We think a reasonable kind of baseline for them is to kind of write down a median rate path of kind of 3.5% by the end of 2025, could even be a little bit lower than that. And so that's the kind of pace, every meeting type of pace over the next several meetings to see how the economy responds. And then they can reassess and make a further decision from there.
Tiffany, we've been talking a lot about 25 basis points or 50 basis points on Wednesday. And before we get into the guessing game of how you interpret the tea leaves that have come out of a number of publications overnight, I am curious about how you will be gauging the trickle-through effect to the real economy of whether they cut 25 or 50. How will you understand how that's being sort of deployed in the real economy?
Yeah, well, I mean, I think if a 50 basis point cut is if they end up doing it, it suggests to us that, or would suggest, I think, that they're more worried about downside risks to the economy, and they want to kind of more quickly get to neutral. We've said they've achieved a soft landing. Now, really, it's going to be about sticking that soft landing and keeping it going. And I think, again, the question is about how quickly they know they need to get to neutral. How quickly do they get there? So that's how we would be reading. I mean, we still think a 25 basis point rate cut is probably reasonable here. We don't think the economy's in recession right now. Certainly the labor market indicators, are worrisome. But we have had this big surge in immigration that is kind of blurring the picture with some of those indicators. So, I think there's a lot of things they have to take into consideration here. And so again, 25 with a sequence of cuts that they signal seems reasonable to us.
Just what I'm trying to get at is what's going to be the actual implementation of lower rates in the economy? Will you be looking for some sort of significant uptick in small businesses borrowing? Are you going to see increases in consumer borrowing or reductions in, say, some of the delinquencies as people's borrowing costs go down? What are the sort of signs that this actually is working at a time where the efficacy of monetary policy has been profoundly questioned as rates went up? And now the question is how quickly it'll be implemented on the way down.
Yeah, I mean, I think if you look at the household sector, we've been talking a lot about this as well. Households just haven't really felt higher interest rates. Many of them have low rate mortgages that they locked in to 30-year periods during the pandemic. So the household sector probably won't feel a lot of it, unless you have new home buyers or first home buyers. But where I do think it could be potentially helpful, is in terms of housing supply. So we've all known that we've been in a period of underbuilding relative to population growth over the last decade post-pandemic or more, and that's resulted just in supply-demand imbalances in the housing market, which suggests to us that as you have rates coming down, you can have real residential investment that picks up. That's obviously going to be helpful for the economy. We think housing investment probably subtracted 1.5 points from GDP in the third quarter. That's a pretty big subtraction. So just getting that back into some modest growth, we think is probably helpful. And you could certainly get that as you have rates coming down.
I'm glad you mentioned housing. There's been this debate on what actually will happen when rates come down. Will people start moving and more supply will come on the market and costs will come down? Or potentially, will we actually see housing prices go higher?
Yeah, I mean, so in terms of, the moving and the existing home sales and things like that, when people move, they usually move from one house to another. So, in terms of the aggregate supply picture from that, yes, you get more churn in the market, but it's not on net really that it shouldn't increase by that much the overall supply of homes. What increases the overall supply of homes is new building. And so that, I think, is really the key. supply. Building, has been slow and sluggish this year because interest rates are elevated. Many builders you talk to say the economics are, make less sense with higher interest rates. And so when rates come down, we do think that, building will accelerate somewhat. And I think that's ultimately good for the economy. It's good for the supply-demand imbalances. Eventually, hopefully, that helps to moderate housing prices. Although, we don't think that they drop, housing prices will probably be, kind of 5% type-ish ranges. But again, I think that's not necessarily a bad thing for the economy.
Tiffany, and just circling back to what Lisa alluded to, some of the tea leaves that are coming out of things like the Wall Street Journal or the Financial Times, if the market is now presented with potentially next week, the Fed going 50 basis points, does that mean now there's outside weight on retail sales next week?
Well, certainly I think if retail sales next week is bad, is much worse than expected, I think that would maybe potentially increase some probability. I think if you just kind of take the broader range of data that we've gotten over the last month or two, labor market data, in our minds is important, and the labor market data that we saw, it wasn't great, but it wasn't terrible either. So it does suggest that labor markets are slowing, and I think the Federal Reserve wants to try to understand what's going on there a bit more. The slowing that we've gotten over the last couple of months, I think, has been more pronounced than many people expected, both in payroll growth and, of course, the unemployment rates ticking up. So I think, they probably look at that and they say, we are a little bit concerned about that. And if you're concerned about payroll growth slowing, the labor market slowing, of course, you'd expect consumption to be slowing as well. So they probably will be looking at retail sales and those consumption indicators, to kind of confirm or deny, if you will, whether the labor market slowing is having a broader impact on the economy.
Tiffany, appreciate the update. Thank you. Tiffany Wilding there of Pimco. Looking ahead to next week, the data, including retail sales, going into that Federal Reserve decision, 25 or 50. But the nuances beyond September, I think, are so important. I don't think we can overstate this enough. When we sit here next week and talk about a September rate decision, we'll have a conversation about 2025 with very limited information about policy in Washington. When we sit here for the next meeting on November 7th, we'll have a much clearer picture, we hope, of what policy might look like in a 12, 18 months, the next 4 years possibly. And it could be a very different conversation.
You've mentioned this before, though. How often has the Fed moved ahead of actually policy getting passed versus just the suggestion of it? And this is a tricky moment because people say that fiscal could ultimately change it. And you know why? Because it could be inflationary. This is the reason why I think that is potentially one of the bigger risks being built into the market is the balance of risks and how this market, how much it's sort of moved past inflation, maybe before the proof isn't really shown.
When it comes to fiscal policy like the tax cuts, that's going to be a long drawn-out debate. When it comes to tariffs, that could be almost immediate. And I go back to what Mike Schumacher said to us earlier this week, which was basically, if you get a Harris administration, the Fed could cut more because she's not going to put up the walls as high as Donald Trump. But if you get Trump in the White House and he decides to put up the walls immediately, and he could do so unilaterally, potentially are we looking at a Fed that might have to recalibrate and start hiking again?
We could have a very different conversation at the Federal Reserve's next meeting after this one in September. Joining us now to discuss is Troy Gayeski of FS Investments. Troy, good to see you, sir. As always, welcome back to the programme. Before we get into the markets, let's talk about the Federal Reserve. What's the base case for you and the team?
Yeah, so 325 basis points cuts. We came into this year thinking 2 to 3. There was some overreaction, obviously, early on that there'd be 6. And then when the inflation data came hot in Q2, some folks were arguing for none. But it's almost a certainty at this point that we're going to get 3 cuts. Clearly, the labor market's softened. There's no doubt about it. Inflation's gotten much more under control. That's the right policy response. And I'll tell you, when you think of credit investors like ourselves or originators of private debt, we're more than happy to trade off some degree of incremental income to further reduce the risk of a recession going forward. And so that's where we're at in the economy, and it's going to be an appropriate response. To your point before, it's now about next year and the year thereafter where there's much more uncertainty. Yeah,
much more to play for. Troy, I want to get to the quote from Tiffany Wilding just moments ago from Pimco. When she said this, and I'd love your reaction to it, developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019. Troy, what's the best argument for that, do you think?
Yeah, so when you think longer term, right, arguably the biggest reason why we should have more sustainable inflation going forward than we did pre-pandemic, and particularly in the post-GFC realm, where, as we all know, the Fed was struggling just to get inflation too, it is a much globally tighter labor market, right? You think of places like Japan or even China now, declining working age population. The U.S. labor market has gotten much more structurally inefficient. So that's arguably reason number one. And then reason number two, of course, is this really desire to onshore production. Obviously, we're going through a period of protectionism. So, I think that debate is new terminal rate 2.5 or 3. We can debate that quite vociferously. However, it's certainly not 0 unless we have some type of major exogenous shock that is unforeseen.
There is this question right now of how much we can really count on just sort of inflation continuing to diminish. And I just want to build on what you're mentioning. How are you sort of countering the assumption in markets that inflation is dead in terms of more contrarian investments that push against that?
Yeah, I don't think we're arguing or most rational market participants are arguing that inflation is dead. It's just that we've made significant progress. And the balance of risks is now much more symmetric between the labor market and inflation. But in terms of counter-cyclical to that thinking, there's really nothing specific there. However, opportunistically, we have to look across markets and try to find areas where there's more inefficient pricing. So, for instance, if you look at most spread product, whether it's high-yield bonds or levered loans, and even in on-the-run private credit, spreads are relatively tight. They're a little bit tighter than they were coming into 2022. You still have very attractive yield. However, if you look over at public markets, what you're seeing is markets are pricing about a 22% probability of deal breaks in each individual deal and mergers. Historically, over 10, 20 years, it's been 5. Even in this environment, it's peaked at 8%. So we're trying to identify inefficiencies like that we can take advantage of in our liquid strategies.
I know you focus on illiquid strategies and some of the private investments. You're talking about merger arbitrage. And let's go there, because this is actually one area that a lot of people don't want to get caught dead in, just simply because a lot of these deals have been broken. And we have seen a very different FTC under Lina Khan. How can you have confidence to go in and bet that deals are going to get done now, given how politicized so many of these deals are actually getting?
Yeah, well, I think, again, that gets back into pricing. Let's say, for instance, markets are pricing in 12 or 15% probability of deal breaks, and the historical average was somewhere between 5 and 8, depending on how aggressive the FTC was or not. It would be a different story. But as an investor, you're always trying to look at market mispricings versus empirical data. And this is one of the more glaring. And we're not going to say it's an overreaction to your point, a very active FTC. It's just presenting itself with a very attractive theme over the next 12, 18 months. And I think at this point, regardless of the political outcome in November, that looks like a very attractive risk reward to us relative to other strategies out there.
Interesting. Troy, it's good to hear from you, buddy. As always, Troy Gayeski there
Great to talk.
of FS Investments. Thank you, Troy. Appreciate it. The personnel changes down in Washington. Big deal for this market.
Yeah, we have to see what happens. J.D. Vance was one of those individuals that thinks Lina Khan is actually doing a decent job, and he looks across the current Biden administration. We should know we've asked Chair Khan to come on Bloomberg a number of times. I've met with her before privately in the past. And, we still welcome her appearance.
Still no appearance?
Still no appearance.
Disappointing. I have to say this, though. Vice President Kamala Harris, based on reporting, also facing pressure to get rid of Khan. And not exactly coming out and vocalizing her support for her either, is she?
We don't have a clarity on exactly what this merger policy will look like or what the FTC will look like, which is one reason why a lot of people are wondering whether you see a surge in mergers that do get completed after the election, regardless of who gets in the White House.
If this started with the conversation earlier this year, at the very beginning of the year. Do you remember with Brian Moynihan of Bank of America?
I do.
Who made this point about deal flow being held up by the fact that we don't know what kind of deal gets through Washington? It's a problem.
I mean, I think Kroger's and Albertsons was sort of the key example. If they're looking at trying to compete against Walmart, if they're looking at trying to compete against Amazon, and if they can't get a deal done because they're being held up as somehow creating more expensive groceries, that creates a real issue of what the threshold is at a time when you have a lot of banks that are potentially going to look to merge and other sectors as well that are looking for a certain economy.
Do you remember the handbag transaction? What was that? Do you remember that one?
That was with
Capri, wasn't it?
Capri, yeah.
Coaching, no handbags, that was a problem. Do you remember that one?
Handbags are a problem. Groceries are a problem.
Groceries
Airlines
make sense.
are a problem.
I can understand the sensitivity around groceries and airlines. The sensitivity around luxury goods, I couldn't get my head around at all.
Clearly, you don't have handbags. You should just try a little bit more.
Worried about entry-level luxury down in Washington. Makes sense of that.
That's the reason why people really are having trouble understanding what deal could potentially get done.
Let's get you an update on stories elsewhere. Let's move on to your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. United Airlines has announced a deal with SpaceX's Starlink, where Elon Musk's company will power their in-flight Wi-Fi. United is now the first major carrier to use the satellite system, becoming a marquee customer for Starlink. The airline said in a statement that it will begin testing the service early next year, rolling it out later in 2025. The yen strengthening this morning for a fourth consecutive day to 140 versus the dollar, the strongest level of the year. Traders told us that hedge funds are in the options market, putting bullish bets on the yen against pairs like the Aussie, Swissy, and offshore yuan. Bank of Japan speak that signaled more rate increases will come has helped the yen advance about 14% versus the dollar since the end of June. Economists surveyed by Bloomberg say the Fed is likely to cut 3 times this year, each by a quarter point. Only a few of the 46 economists surveyed anticipate a larger half-point reduction at the November-December meeting. However, respondents do think that policymakers will pursue a more aggressive rate cut path in the years ahead. And that's your brief, John.
Danny, thanks for this morning. Have a great weekend. Up next on the programme, we'll set you up for the day and the week ahead. That's just around the corner from New York. This is Bloomberg. Counting you down to the opening bell, here's the trading diary. The week ahead, your agenda, the calendar at 10 a.m. Eastern Time. We'll get UMich consumer sentiment data at noon. Donald Trump holding a news conference in California as Kamala Harris prepares for a rally in Pennsylvania. On Tuesday, the data kicks off. It's retail sales. And the FOMC two-day meeting begins. On Wednesday, it concludes. A Federal Reserve rate decision followed by a Chairman Powell news conference. Happens on Wednesday. We'll get some forecasts as well. On Thursday, another round of jobless claims. And on Friday, a rate decision from the BOJ. With us around the table, Mike McKee. Good morning, Mike.
Good morning.
Let's get into this. What do you make of some of the recent commentary? The shift back towards 50, it seems, at the Federal Reserve.
Wish being father to the man. I'm not sure exactly. Obviously, we had stories in the Wall Street Journal and the Financial Times yesterday that suggested that it's a close call. I don't think anybody would argue with the fact that it's a close call. It doesn't. If the bottom line question is, did Jay Powell call up and tell them what they're going to do? No, I don't think so, because both stories were rather ambiguous about it, but it does raise some questions in people's minds. So maybe loosens up the mark a little bit in case there were something. But we're still a long way away from Wednesday, and we have retail sales coming up. I know you were talking about that earlier, and that could be something that pushes the Fed one way or another as well.
Do you think that the Fed welcomes or pushes back against the idea that people don't know whether certain things, articles, are tea leaves or whether they are just simply reflecting the market discussion?
Well, I mean, if they are leaks from the Fed, it's a deliberate effort to steer the markets. And we saw that back in June of 22 when the Wall Street Journal got a call from the Fed and published a story that basically pushed the markets into the 75 basis point cut because the Fed doesn't like to surprise markets. But in this case, you've got a situation where now it's not going to be a surprise if they do 50 or 25. It's just that we haven't in so long had a live meeting where it could go either way, where what they do matters as much as what they say.
How much focus do you think, besides Jay Powell, is everyone else on the FOMC looking at stories like this when everyone came out and basically said, yeah, it's going to be 25 basis points, and now there's start whispers of maybe it's going to be 50?
I don't know that they really pay a whole lot of attention to it. If it were a leak from somebody, then that person would be paying attention to it. But this is the day the Friday before the meeting when Jay Powell gets on the phone and speaks to everybody one after another and kind of takes the temperature of where they are.
So it would be the perfect day to put stuff in
I
newspapers.
suppose it would be the perfect day if that was his goal. But I think each one of them comes into the meeting with their views fairly set about what they're going to do because they have to make a decision. So they've been sitting, especially the bank presidents, have been sitting with their economists and people in their banks and coming up with a decision for each of them to bring into the meeting.
It's the first live meeting in a long time, and I can't wait to see the back of it. Michael McKee, thank you, sir. Coming up on Monday, I'm sure everyone feels the same. Laurie Cavacina of RBC, Savita Subramaniam of Bank of America, Pimco CEO Manny Roman, and Megan Robson of BNP Paribas. All of that to come next week. From New York, thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.